financial conditions are incredibly loose.
The market in fixed income is definitely volatile.
Equity volatility, for the most part, has been low.
It can look a certain way at the index level, but there's opportunity under the surface.
I don't feel bearish by any stretch, but valuations feel full.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
These weeks are absolutely flying by. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now as we kick off a brand new trading week on the longest winning streak of the year so far on the S&P 500, following a sixth week of gains on the S&P just last week after closing at another all-time high. Equity futures on the S&P 500 shaping up as follows, pulling back by about 0.1% on the Nasdaq 100. We're down by around about a third. The Russell, the small caps, just about unchanged. Your week ahead looks like this. Look out for the beige book and the beginning of the IMF World Bank meetings. Why? Because there is a big divide emerging between the United States and the rest of the world. Just listen to the commentary over the weekend. Apollo, no landing continues. UBS, a no landing US economy. And Bank of America considers the other R word. Lisa, reacceleration.
So here's the question. How much can the U.S. reaccelerate, especially as you point out that huge divide between the U.S. and Europe, very much in focus at the IMF. It's the reason why I think a lot of people are going to be talking about the deficit in the IMF and the possibility of yields going higher. You've already heard that overnight with a number of different analysts, including T. Rowe Price, talking about 5% 10-year yields. But now the question comes to what is the consequence of a reacceleration other than just people liking U.S. assets?
We talk about those 5% 10-year yields in a treasury market and just the sound of people leaning a little bit more heavily into the so-called Trump trade. Note after note, and again this morning from Mike Wilson over at Morgan Stanley.
So here's the question, and I actually was reading a lot about this weekend. What is the Trump trade? People are talking about it being the financials. People are talking about it being the yield curve steepening. People are talking about how you get small caps that are rallying, and that's all part of it. At the same time, it's unclear what will actually be the Trump trade after the fact and how much of the odds change. But this seems to be the real question right now as we've reached the final stretch heading into the election.
It almost feels like there's two Trump trades. There's one in the betting markets, which Trump is handily winning, and many people are speculating is there's some sort of whale in the markets. And then there's actually the financial markets. And you brought up Wilson and his point. He says markets appear to be rotating more towards Trump with a scenario over the past several weeks. Equity market leadership has looked more like 2016 election playbook. Meanwhile, bonds have sold off and several precious metals and cryptocurrencies have continued their upward momentum, especially when it comes to the likes of something like gold.
Bonds are selling off again this morning. Yields are higher at the front end of the curve on a 2-year by 4 basis points, on a 10-year up by 3 or 4, supported by the move in oil. Terrible week last week. Crude was down by around about 8%. It's bouncing back this morning. We'll build on that a little bit later. I want to talk about a single name this morning. It's Boeing. Do we finally have what might look like a deal over at Boeing? That stock is higher by 3.9%. The offer on the table, it's a big one to be fair, a wage increase of 35% spread over 4 years.
But we have a deal almost tentative. Why? Because in September, when the leaders of the union and Boeing reached an agreement, it was overwhelmingly rejected by the 33,000 union workers. They said, no, this doesn't go far enough. So it's a tentative agreement. It was struck over the weekend. The most interesting aspect of this, I think, is when this potentially could be or not be ratified. And that's Wednesday, Lisa, after they come out with earnings earlier in the morning.
Yeah, October 23rd, right? This idea that suddenly all of the union members get to vote on this and the union leaders have not endorsed it. They haven't said you should sign off on it because of some of the pension issues, because of some of the benefits on the other end. It just really goes to show that Boeing's 41% decline has been a drip, drip, drip down. Unclear if this can really stave that off.
And this is a small bounce in the context of that big drip lower. We're up by around about 4% in the pre-market this morning. Equity futures pulling back, as I say, just a little bit. We're down by about 0.1% on the S&P 500. In the commodity market, we'll build on this later. Crude back through $70.36. We're higher by 1.65%. Coming up this hour, your lineup looks like this. Dan Morris of BNP Paribas following 6 straight weeks of gains on the S&P 500. Stephen Cook of the Council on Foreign Relations as Israel hones plans to attack Iran. And Nela Richardson of ADP on why a boring economy is the best kind of economy. We begin this hour with stocks sitting near record highs after posting their longest weekly winning streak so far this year. Traders looking ahead to a busy week of quarterly results. Dan Morris of BNP Paribas writing, US earnings are driving outperformance of the equity market. Still early in the season, but results are encouraging. Risk, if anything, is that growth is too strong and the market is too optimistic on the path of rate cuts. Dan joins us now for more. Dan, welcome to the programme, sir, as always, and good morning to you. Do you think there's too much of a good thing going on right now, then, in the US economy?
Well, we probably should enjoy it while it lasts. We know that bad things inevitably happen. We'll have some type of negative surprise, and it won't be another 6 weeks or 6 months of continued gains for the market. But broadly speaking, if you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that. We believe we're on a path to a soft landing. Rates are going down. We can discuss all day about how quickly that's going to happen and when the cuts are going to take place. But for now, we're kind of waiting for what that negative shock might be. But the economy does look resilient.
Dan, you say soft landing. UBS says clients are asking us about a so-called no landing. What's the difference between a soft landing and a no landing? And how, from your perspective, does your approach to capital allocation decisions shift with either in mind?
Well, I think my interpretation of a no landing was that you actually don't get growth back to the long run average for the economy in the U.S., which would be, say, 1.75%. And clearly we're well above that now. The last I checked, the Atlanta GDP now forecast from the Fed was 3%. So, we're quite a ways to go. And that's where we get into the dynamic of how quickly the Fed is going to actually cut rates if growth stays that strong. So I think that's going to be the dilemma. That's where perhaps you have some mispricing in the market. Too much optimism on the rate front, but from an equity point of view, that's not per se such a big problem.
At a certain point, though, Dan, you have to wonder about whether the earnings ratify the sort of no landing scenario. And a number of different strategists pointed out that we have seen downward revisions to some of the forward-looking projections, particularly for some of the cyclical companies. How much does that raise concerns about you as we parse through the earnings of the likes of auto companies later this week?
Well, Lisa, I think the key thing to keep in mind, revisions clearly are important. Positive revisions are better than negative revisions, but we want to look at the absolute earnings growth that we think we're going to get. So even if you have negative revisions, but earnings are up a year from now, really the market should be up as well. So you want to keep it in perspective. Kind of inevitably, analysts tend to be too optimistic, so they revise down those estimates. But if there's growth behind it, that's going to be what matters.
Dan, how much are you trying to understand what the Trump trade is, what the Harris trade is, and how to really game that out at a time where maybe earnings matter, maybe the Fed matters, but right now all the oxygen's been sucked out of the room for the next 2 weeks?
Well, to some degree, at least over the next 2 weeks, argue perhaps the opposite. I think the election outcome is so uncertain. I think it's challenging for a lot of investors to think about how they would try to play an outcome, particularly when what honestly I think is going to matter at least as much, if not arguably more, is what happens in Congress, because that determines what the victor will be able to do. If it's divided Congress, clearly you have much more limited scope. If there's a sweep either way, and really anticipating that now, I think it would take a quite brave person.
Daniel, given that, the fact that we need to know the composition of Congress, and also the fact that if you look at these swing state polling, they're on a knife's edge. It's 50-50. It's a coin flip when it comes to this election in 2 weeks' time. Why do we see the markets rotating, though, towards a Trump trade?
Well, I guess, as you pointed out, it all depends how you interpret it. I guess our focus is more on the medium-term outlook for the economy, and really under kind of any scenario you think you have for the results of the elections, it is still a quite positive outlook. Now, there's going to be difference on maybe what sectors do well or worse, depending on the configuration. But at a high level, we're optimistic, if you will, and have our overweight in equities in the U.S.
So basically what you're saying is regardless of the U.S. election, compared to the rest of the world, especially when you look at what's going on in China and the data there and Europe, the U.S. remains in this exceptionalism realm.
Really, it is hard to find another major economy right now that can match the performance of the U.S. We'll see how long that lasts. But for now, at least, it does seem to be on a pretty positive trend.
Hey, Dan, it's good to hear from you, as always. Dan Morris there in London of BNP Paribas on the so-called Trump trade. It's super difficult to disentangle what is driving this market at the moment. Is it the so-called Trump trade? Is it the economic data? Is it a mix of both? Let's take the financials. Financials are doing nicely, but you could say that's all about the earnings. Let's take the Treasury market. It's been selling off, yields are high, but you can say that's all about the economic data. It's very difficult to disentangle what is what and what it isn't.
There was a whole Wall Street Journal article over the weekend trying to disentangle this. And basically, for every single company or set of companies that was rallying or selling off, you could come up with a logical explanation in the market. You could also point to a real continuation of what we had seen before the betting markets really changed. So when you start parsing through this, how much, like Dan, are people saying, actually, we're focusing on the fundamentals because good luck if you really want to bet this out, and how much are people actually trying to delineate what could potentially win?
The fundamentals don't change in terms of potentially the U.S. being the cleanest of the dirtiest shirts. And Jonathan, you talked about this yesterday. Regardless, the walls seem to be going up around the world. And if you want to do business in America, you might have to come into America under either administration, but especially under the Trump administration. What I find so interesting about this is what Daniel's point was. How do you put on these bets when it's not just the White House that's up for grabs? You don't know the composition of Congress. You don't get a 15% corporate tax rate if you have a democratically controlled Congress. So this is what is so challenging about the election in 2 weeks.
If you get a red sweep in 2 weeks' time, it's not a base case for many of you, but if you do, you can imagine 10-year yields moving 50 basis points in 2 days. If you've got that kind of sweep. Why? Because all of the promises on the campaign trail, the fact you're going to extend the tax cuts and throw in even more tax cuts on top of that, the Federal Reserve's going to have to back away. It won't just be the long end. It'll be the front end too. So
here's the question. I think that that's astute and I think that that's accurate. I think the question is that going to be bad for stocks or good for stocks? And we've really talked about, what is that threshold at a time where yields used to be a potential liability if they got too high for equity valuations? Is it still that way if the reins are released and you still have tax cuts and you have a whole host of other deregulatory actions? These are some of the questions that people have, and you can't answer them, which is a reason why a lot of people are saying, la, 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 la.
Yields are up 4 basis points, and we'll be saying that until 2 weeks' time. 15 days to go. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Speaking of those just 15 days to go, VP Harris is leading Donald Trump in fundraising. Filings show that the Harris campaign raised $221.8 million in September. That's more than 3 times the amount raised by the Trump campaign. The latest Real Cleo Politics average of national polls shows that the race is still neck and neck, with Harris leading Trump by just 0.9%. Elliott Investment Management and Southwest Airlines may be heading towards a truce. According to people familiar, the two are discussing a potential settlement to avoid a proxy fight for control of the airline's board. Elliott has proposed a framework that would give it representation, but not control of the board. The talks haven't been finalized and could fall through, those people familiar said. And what a weekend for baseball. The 2024 World Series matchup is set. It'll be a battle of league heavyweights with the New York Yankees and LA Dodgers facing off for a record 12th time in the World Series, but for the first time in over 40 years. Sorry, Lisa, but the Dodgers did indeed take down the Mets in their 6 games behind their high-powered offense, with superstar Shohei Ohtani heading to the Fall Classic for the first time in his career. They're going to face a Yankee team back in the World Series for the first time since 2009, with sluggers Juan Soto and Giancarlo Stanton leading the way for the New York team. Game 1 begins this Friday in LA. And that's your brief, John.
Danny, thanks for that. Appreciate it. Juan Soto, Saturday evening in Cleveland, just absolutely phenomenal. Have we got the game report?
Do you know what they call him now? Mr. Wonderful. I'm so sorry, Lisa, but the Yankees are the champions, and now they're going to the World Series. We are so excited.
Do you know why Lisa's happy? Because they didn't quite fit in the Yankees jersey then, the Yankees jacket. Yeah. I think the banner was covering it up.
I'm watching the bond auctions. There's actually a 20-year on Wednesday that's
Are you
coming
wearing
out.
that for the rest of the show?
I think I should. It's more comfortable.
I totally disagree.
Okay.
Doesn't
We'll see
really
how that
match.
works out. Up next on the program, Elon Musk shaking up the campaign.
Every day from now until the election, we're giving out $1 million prize. And all you have to do is sign a petition in support of the Constitution.
That conversation up next, live from New York City this morning. Good morning. All-time highs at the end of Friday's session. What's that, Lisa? Number 47?
Yeah, something like that. I don't know.
47.
I'm counting equal weight.
still counting higher? Where are we in equal weight?
I actually don't know. I think it's 25. Okay. But we actually did last week. I just want to point out small caps outperformed, that it was still that rotation that really has been the hallmark of this trend.
That's super helpful.
Isn't it?
Thanks for that.
Anytime.
Equity futures on the S&P a little bit softer. We're down by 1/10%. Under surveillance this morning, Elon Musk shaking up the campaign.
Every day from now until the election, we're giving out $1 million prize. That is, and all you have to do is sign a petition in support of the Constitution. It's very straightforward. You don't even have to vote.
So here's the latest. The Tesla chief saying the super political action committee he created will be giving away $1 million a day until election day to a signatory of a petition calling for free speech. Democrats are expressing concern.
I think there are real questions with how he is spending money in this race, how the dark money is flowing, not just into Pennsylvania, but apparently now into the pockets of Pennsylvanians. That is deeply concerning.
Joining us now is Jack Fitzpatrick of Bloomberg Government down in Washington, D.C. Jack, let's start there. What is so deeply concerning about it?
Well, first, Democrats can make broader complaints about Elon Musk's support for Trump. They have complaints about how he runs X, formerly Twitter. There are more specific legal concerns that I think not just Democrats, but some scholars immediately have, because in addition to the comments you just played, Musk has said this $1 million giveaway is based on an eligibility requirement of you have to be a registered voter, and that may be illegal to require people to incentivize voter registration with cash giveaways or check giveaways. So there are some legal concerns that could be really interesting that we may see play out between now and Election Day with regard to the $1 million giveaway. But that's in addition, that's kind of the icing on the cake of Democrats' heartburn over the role that Elon Musk has played more broadly in favor of Donald Trump.
Well, we saw already over the weekend, he already doled out 2 of those checks, one in Harrisburg and, of course, one in Pittsburgh. This is a must-win state for the Democrats when it comes to Pennsylvania. So what are they doing to potentially combat this, Jack?
Well, there's going to be a huge spotlight on Pennsylvania from now through Election Day. Kamala Harris is going to spend a lot of time there. I think it's safe to say she's going to be there today, in addition to Michigan and Wisconsin. The money giveaway also raises some strategic questions about what exactly the goal is here. We're close to the election. It raises awareness, seemingly, of a PAC that supports Trump. It's not something that the Trump campaign specifically is doing. So you're probably going to hear Democrats, and you heard Josh Shapiro, but you're going to hear some concerns from Democrats about Elon Musk's activities here. But the strategic response may just be more of the same, more time and money in Pennsylvania. It's kind of part of the triumvirate that when you look at Pennsylvania, Michigan, and Wisconsin, Harris doesn't technically have to win all 3, but she really wants to win all 3. So you're going to see more campaigning, plenty of money going into the airways in Pennsylvania, and just a huge focus on Pennsylvania from both candidates.
Well, no Democrat has won the presidency without Pennsylvania since 1948. So I think they view this as a must-win state. Following the money, overnight, we got some of the details about how much each campaign is pulling in. And the Harris campaign set a record for the biggest fundraising quarter ever this fall, raising $1 billion in the 3-month period that ended at the end of September. What are they doing with all this cash?
They have some questions outstanding. I mean, they're spending it. They don't have a huge burn-through rate. Harris had an advantage even before these most recent numbers, more than $220 million raised in September. She came into September with a more than $100 million cash-on-hand advantage over Trump. The question is exactly where they spend that money, how much goes to the logistics of the campaign, exactly how much goes to the airways, TV ads, which states get that. There is, as I said, a huge focus on Pennsylvania, Michigan, and Wisconsin. It does not seem that Harris is forgetting, though, about Georgia or Arizona or even North Carolina. So there are outstanding questions about the details of where they spend that. But for now, we know, yes, there is a significant financial advantage at the end of the campaign here for Harris over Trump.
Jack, how much of that money is going toward the post-vote analysis and the post-vote potentially legal challenges that a lot of people are expecting?
You have some money left over typically in a campaign that does go to legal expenses. It tends not to be a huge percentage. If you're trying to do the math on what the effect is on an election, they're not saving up a massive amount of money. And if it gets really messy, which is a possibility with legal challenges, there could be further fundraising by other groups that try to get involved.
The reason why I ask this, Jack, just sort of putting together some of the issues, Elon Musk and sort of the payments that he was putting out there, there is a federal law that makes it a crime for anyone who, quote, pays or offers to pay or accepts payment either for registration to vote or for voting. There also are questions around the safety of campaign workers and things like Maricopa County. And there's been a real question, regardless of Republican or Democrat, and there is an increasing amount of security. You just have to wonder how much you have actual members of the campaigns trying to ensure the security or just to oversee different aspects of this that inevitably will get litigated.
Yeah, those are very significant concerns. Financially, a lot of the responsibility doesn't fall just to the campaigns themselves. Right before Congress left, you probably remember the addition of about $125 million for the Secret Service to ramp up protection for the presidential candidates. As we said, the governor of Pennsylvania has said he has concerns about the legality of the Elon Musk cash giveaway. If it's in violation of the law in some way, there may be state officials that look into it. Really, it's probably safe to say, despite the increase in a variety of costs around the logistics of the election, the fundraising advantage that Harris has is still largely going to be focused on the typical campaign maneuvers and probably won't be massively drawn away by all these other storylines.
Jack, you spend most of your time in the halls of Congress. What congressional seats or Senate seats are you most watching next week?
It's hard to narrow it down, but if I were going to name a couple, I would say that the Senate is so pivotal and so important. If Harris ends up winning, she still may have a Republican Senate. I would say the uphill battles that Democrats like John Tester and Sherrod Brown face, those are really tough races in Montana and Ohio. They need to do well there for a possible President Harris to have any chance of a real ability to follow through on her legislative agenda. So the red state Democrats are, I think, the most interesting races to watch. And I would say probably Tester and Brown are the two toughest ones for Democrats.
Hey, Jack, good to see you. Jack Fitzpatrick there of Bloomberg Government down in Washington, D.C. What did we think of the McDonald's routine over the weekend? What did you think of that?
Mick Trump. A lot of people in the Trump world sent me his photos, excited about it, thinking that it worked. I mean, it got a lot of play across social media, these videos of him frying up French fries. There you have it. And then, in the drive-through window, taking people's orders. I mean, it was a stunt. It was a political stunt.
You don't say. Taking digs at a vice president as well, suggesting that she never actually worked at McDonald's. This is where we're at, 15 days out. We're still arguing over this.
This is the reason why I think a lot of investors are trying to ignore this, and yet you can't. I mean, the idea that, A, the customers were actually pre-selected to drive through and pre-vetted the sort of, oh, it's salted. Oh, yeah, don't burn your hand, and also don't get it on your, button down.
AMH, mention the numbers. The numbers matter. Outraising Trump more than 3-1 last month. The Harris campaign, the numbers are absolutely phenomenal. Yet this race is still very, very tight. Up next on this programme, we'll catch up with Stephen Kirk of CFR as Israel ramps up attacks against Hezbollah in Lebanon, following the biggest weekly loss on crude of the year so far. We're bouncing back this morning on WTI and on Brent. WTI and Brent crude this morning higher by around about 1.7% on WTI. On Brent crude up by 1.4%. That's $74 on Brent. On WTI, $70 and about 42 cents. 6 weeks of gains on the S&P 500. Equity futures just a bit softer this Monday morning. We're down by 0.2%. Apollo's Torsten Slok talking up the no landing. Says the no landing continues. Gives a ton of reasons for it. Here's 5. Just 5. There were more. Pick 5. A dovish Fed. High stocks and high home prices. Public and private financing wide open. Continued support from fiscal plans. Low debt servicing costs. Locking in low rates. And the list goes on and on.
So this is increasingly more of a base case than not, this idea that where is the downturn and the deceleration if you see these kinds of earnings and expectations from the likes of banks. My question is, how much of this is priced in? And that increasingly was the tenor of a lot of the notes over the weekend, whether it was David Kostin or whether it was Mislav Mateka over at JP Morgan. We know all this. Now what when it comes to stock valuations?
It's why we've seen this push higher in bond yields. Switch on the board and turn the page and get to the bond market story. This morning, 2-year yields are higher by 4 basis points. The 10-year also up by 4 basis points. The 10-year at 412.43. And if you switch at the board again, this speaks to crude. Once more, WTI and Brent bouncing back by 1.4%. Just breathing some more life into that trade. Treasury's lower. Lisa, yields are higher.
Everyone's looking for when will Israel respond and retaliate to Iran, which might be giving some of the lift to Brent crude. I say might be because you can also point to more stimulus out of China. You could also point to perhaps some of the growth aspects. It has been one of the more difficult trades to really fully understand in full. But this has been sort of this ongoing connection with yields and oil prices, regardless of long-term inflation trends, that seems to be, at this point, still very much in contact.
The next trade hasn't been a difficult trade. It's been a one-way street through most of this year. It's gold. It's up again this morning. It's another all-time high. It's a 5-day winning streak. Gains so far this year of more than 30%. And this came from Mohammed El-Erin in the Financial Times today. What is at stake here is not just the erosion of the dollar's dominant role, but also a gradual change in the operation of the global system. Fantastic column out there on the FT this morning on the back of this move in gold, which has been absolutely phenomenal.
And it really draws into question whether it actually is a structural shift, especially as central banks around the world increasingly look to allocate just a little bit more to gold. And you start to think about that in addition to potentially individuals in China who don't have necessarily confidence in investing in home prices.
Mohammed talks about the fact this isn't just an inflation hedge. This isn't just about geopolitics. It's that fact exactly. Central banks around the world starting to buy more gold. Why? Issues, tariffs, export controls, sanctions. They're looking at other ways to potentially de-hedge against the U.S. dollar. And that is why you've seen this uptick in gold. And that's why potentially it just has only one direction to go, as you said, higher.
The grind higher continues this morning, up 0.25%. Under surveillance this morning, the latest out of China. Chinese banks cutting their benchmark lending rates, the latest measure aimed at reviving economic growth and halting a housing market slump. The size of the LPR cuts beating expectations, but still within the PBOC's forecast range.
So there are a couple of questions. How much remains in terms of this year versus ahead of next year when we do have an understanding of what the outcome to the election is? But the other question here is, what's the ultimate goal of Chinese authorities? Is it to really support housing prices? Is it to put a floor under how much the economy can deteriorate? And what does it say about just how slow the economy actually has gotten? And I think that that's what people are trying to get their arms around, especially with some of the earnings that we've seen out of Europe.
I'm glad you mentioned the election, because there was this thinking before we had that stimulus from China, especially from the likes of Goldman Sachs, saying that maybe they're going to really withhold that firepower until they see the outcome. If it's Donald Trump and there's tons of tariffs, they might then want to use it. Jefferies this morning talking about the fact that a Trump win is a buying opportunity for Chinese stocks. They say, quote, the track record shows that Trump is not as anti-China as he is perceived to be. People have forgotten that Trump did a big trade deal with China in January 2020. This is very contrarian to everyone else who comes on this program and says that Trump is going to be much weaker for China.
When it comes to the equity market, I think it's really important. I came up with a phrase years ago in the last election cycle, the one before the last election cycle, the so-called presidential put. It's a presidential put. It's a different kind of story. We've talked about it around this table. If he becomes president for a second term, we know what regulates him, and it's the financial market. It's the S&P 500 or the Dow Jones. We know what it is. And that's ultimately what brought the two sides together as well, the US and China. It was market forces putting a little bit more pressure on both sides, one side more than the other, to come to a deal.
So here's the issue. Does the market force a much more easier framework for some of these tariff negotiations or trade rules, or does it not, right? Is that the same kind of regulatory force that really does rule what the former president would do in the second term?
How many times did we see during Trump 1.0, he'd come out with an idea, maybe leaked to the press, maybe said on Air Force One. By the time he touched down, it was reversed or it was massaged to be a bit of a softer tone. Why? Because after he came out with that statement and places like Bloomberg News ran a red headline saying this is coming from the President of the United States. He's saying he's going to pull out of XY trade deal and markets tanked. Then he realized, oh, well, that's not good for the U.S. Inc. And then he started to roll back. So to your point, he is regulated by the Dow Jones and the S&P 500. Will it work, I question, in Trump 2.0?
My favourite example of this, my absolute favourite, I think it was a month in summer, it might have been in August. Markets were having a difficult patch. And I remember the former president said he'd had a phone call with President Xi. And it was a phone call the Chinese apparently knew nothing about. And everyone walked around and said, the president's lying about having a phone call with Xi. And I was like, no, that's not the right takeaway from this. The right takeaway is that he's concerned enough about the market price action that he's ultimately come out and pretended to have a call with Xi. And all of a sudden, we thought we were going to get a deal. Do you remember this?
I do.
It's absolutely
remember
ridiculous.
This so well.
It's absolutely ridiculous.
It also, though, it speaks to exactly your point, which is what the main concern is. And that, I think, is what a lot of people believe that will be the case in the second term as well. And I think that that's kind of the idea behind what you were talking about.
More on this a little bit later. Let's get to the latest on Boeing and the Machinists Union hammering out a tentative agreement. The boost paid by 35% over 4 years. Union members set to vote on the proposal on Wednesday, the same day the company is set to report earnings. Boeing is up by 4%. This is a bounce. Will it stick?
Yeah, especially given the fact that, A, we don't know whether it will be ratified. It will be ratified potentially on Wednesday. We don't know because a lot of the leaders have not signed off on it. But then what, right? How does it then figure out what Boeing looks like in 5 years? Because a lot of people think there is no way it's going to look like how it looks today.
Wednesday is going to be really difficult for the CEO. Has to come out, give this earnings call. Everyone is going to ask whether or not they have this agreement, what his thoughts are on it. He really can't say much. And then we have to wait hours later for potentially the ratification of this deal or not. You have to remember, in September, a deal was struck between the union leaders, and overwhelmingly the workers said, no, it doesn't go far enough.
There's so much pressure on this company at the moment. Look out for that on Wednesday, I believe. Let's get to the latest from Elon Musk. His super PAC pledging to give away $1 million a day until the election to someone who signs a petition calling for free speech and the right to bear arms. Musk saying in a post on X, his pro-Trump group will pick a random registered voter in swing states to win the prize through November 5th.
And he's already done this. He's already done this over the weekend twice. $2 million checks going out to these individuals who signed this petition. Now, the question is this legal or not? Does this go against U.S. election laws? You had Governor Josh Shapiro of Pennsylvania coming out over the weekend, speaking on Meet the Press on NBC. He previously was the state's attorney general. So he didn't put his thumb on the scale too much, but he did say this is something that, quote, law enforcement can take a look at. There's going to be a lot of criticism towards Elon Musk and what he's doing on his social media platforms and the money he is piling into this campaign.
Federal law makes it a crime for anyone who, quote, pays or offers to pay or accepts payment either for registration to vote or for voting. Elon Musk is making that line very blurry. And so it starts to be really what we have seen so consistently throughout this election, which is that in spirit, maybe there's a violation, but the effort to sort of manipulate around the edges, not the election, I'm not saying an election manipulation, but the concept of legality has just been, really pushed to the edges. And that's what we're seeing in this particular case.
Pushing a boundary over the weekend, that's for sure. Let's get you the latest in the Middle East. This from Israel. Launching attacks against Hezbollah's economic strongholds in Lebanon, a day after a drone exploded next to Prime Minister Netanyahu's home. A senior Israeli intelligence official saying the aim of the strikes is to target Hezbollah's ability to function. The attacks coming as Israel weighs its next move against Iran. Joining us now, Stephen Cook of the Council on Foreign Relations. Stephen, welcome back to the programme. I'll ask a difficult question to start. Do you have a base case on what Israel's response to Iran will be? Because another weekend has passed with no action. We're still waiting. What is your base case now?
Well, my base case remains essentially what it was before, that the Israelis are going to go after those Iranian assets that most threaten it, Iran's ballistic missile capabilities, its manufacturing capabilities of those ballistic missiles, as well as important regime targets like the IRGC. Although the attacks on banks in southern Beirut, this is a financial lifeline for Hezbollah, suggests perhaps that the Israelis are not going to heed the advice of the Biden administration and go after economic targets in Iran. Clearly, the Israelis are interested in disrupting the ability of both Iran and Hezbollah to operate, and going after oil infrastructure or other financial assets like they've done in Lebanon may be in the offing for the Israelis.
We do know that Biden's energy czar, Amos Hochstein, is now in Lebanon. What kind of conversations do you think the administration is having with Lebanon right now?
Yeah, I think the administration believes that with a greatly weakened Hezbollah, there is an opportunity here for the Lebanese government to begin to extend its authority into the southern part of the country. I think this is mostly a pipe dream. Lebanon does not really actually have a government. There's been some talk of having elections. I'm not quite sure under the current circumstances how to even organize elections, especially when there's not much of a central government. But nevertheless, the administration continues its diplomacy. Here's the difference between the United States and the Israelis. The United States wants a deal, and the Israelis want to win this conflict. And that's where all the tension is coming between the two countries.
When it comes to potentially Israel's retaliation on Iran, how much weight do you think the Biden administration actually has on Netanyahu right now?
Well, we've heard it before. The Netanyahu government has said, we take America's advice very seriously, but we're going to secure the country as we see fit. And if you look at this conflict as it has unfolded over the last year, every time the administration has offered their advice, pressured the Israelis to do something, the Israelis have gone about and done it the way they wanted to anyway. The Israelis have clearly come to the conclusion that they're getting bad advice from the United States. So while they'll listen, they're going to continue to advance their own interests and calculate how to prosecute this war based on their own judgment.
Any clout that the U.S. had, how much did it lose, Stephen, over the weekend with the reports about a leak of intelligence around what some of Israel's plans could be?
Yeah, there's some debate as to whether this was actually a very significant breach. The fact that the breach happened is important, but whether the information that was leaked it actually reveals much about what Israeli plans are is open to debate. Nevertheless, clearly someone wants to put a brake on Israeli operations. There is a sentiment within the permanent foreign policy bureaucracy that the Israelis are looking to draw the United States into a conflict with Iran. And this may have been someone's effort to prevent that from happening.
Meanwhile, do we have a sense of what's taking Israel so long? We know that they were going to retaliate. We know that they have plans. We know that there was a 7-hour meeting over the weekend where a lot of people were discussing. Is there a sense of the time frame or why there has been a delay in understanding what that kind of response would look like?
Quite frankly, I'm surprised it's taken the Israelis this long to respond to the Iranians. I thought it would be much quicker. They clearly are deciding on the best way to inflict the most damage on the Iranians without necessarily inviting a very significant response, something that the Iranians have promised. At the same time, the Israelis may very well also be negotiating with their allies in the region about how to use their airspace and how best to attack the Iranians without inviting retaliation on them. So this is a very complicated operation. Iran is far from Israel. But really, it's not a question of if, but when. And it's likely to come in the coming weeks, if not days.
Stephen, we heard from the Prime Minister's office yesterday saying Netanyahu reiterated what he also said publicly. Israel takes into account the issues the U.S. administration raises, but in the end, will make its decision based on its national interests. This was in response to not speaking to the president of the United States, Joe Biden, but speaking to the Republican challenger and candidate, Donald Trump. Is this appropriate?
Well, it really is quite extraordinary that you have the Israeli prime minister talking with the Republican candidate about Israel's national security and the U.S.-Israel relationship. It's clear that Prime Minister Netanyahu has long felt more comfortable with Republican presidents than he has with Democratic presidents. Although this isn't to suggest that he had such a smooth relationship with President Trump. One of the things that we learned from Jared Kushner's memoir is that the trust deficit between President Trump and Prime Minister Netanyahu was quite significant, perhaps not as significant as it was between other presidents and Prime Minister Netanyahu, but nevertheless, it was a problematic relationship.
Hey, Stephen, appreciate your thoughts as always. Stephen Cook of CFR. Wasn't John Kerry accused of shadow diplomacy with Iran a number of years ago?
Yes, when the Trump administration came in and they were trying to salvage the nuclear agreement. Lines get blurred, especially in election years before or after U.S. presidential elections, and he got a lot of criticism for that.
One thing that's super concerning to me that we haven't covered enough, and I think we should do in the coming days, reports of North Korean troops going to fight Ukraine. That is one heck of an escalation.
Two things stand out to me. One, again, not very appropriate, but two, how depleted is the Russian military and army and their defense posture if they're having to rely on North Korea to send in troops? We know that Kim Jong-un and President Putin have a very close relationship, but this takes it to another layer, another level of the coordination between these two.
Well, and it raises this question, and I'm glad you bring this up, about how close that nexus is of Russia, North Korea, and Iran. How depleted are the forces, to your point, Anne-Marie, with what's going on in Ukraine and Russia, to really distract from Iran? Or is this really becoming an axis unto itself?
Getting much closer over the last few years. Crude is higher this morning by 2%, WTI $70, Brent crude $74.34. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Vice President Harris sat down for an interview with Reverend Al Sharpton this weekend. She was asked about the former president's, quote, street talk on the campaign and use of vulgar language to describe her record as vice president.
What you see in my opponent, a former president of the United States, really is, it demeans the office. And I have said, and I'm very clear about this, Donald Trump should never again stand behind the seal of the President of the United States. He has not earned the right. He has not earned the right. And that's why he's going to lose.
Harris predicted that Trump's lack of decorum would be a disqualifier with voters. T. Rowe Price says 10-year yields will test 5% in the next 6 months. The firm's CIO fixed income, Arif Hussain, made the call in a recent note, pointing to rising inflation expectations and U.S. spending. Hussain said the ongoing issuance by the Treasury is flooding the market with new supply, pressured further by the Fed's balance sheet reduction. Bitcoin, meanwhile, flirting with $70,000. Data compiled by Bloomberg show that the U.S. spot Bitcoin ETFs lured almost $2.4 billion of net inflows in the 6 days through October 18th. The rally is in part due to bets that U.S. crypto rules may become friendlier after the presidential election. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, calm before the election storm.
You're going to have ongoing, very high deficits, regardless of the outcome of the election. But the trade part of this, the risks around the global trade war, domestic impact in the US and the international impact does affect, everything.
That's next on the program, live from New York. You're watching Bloomberg TV. Session lows pulling back from all-time highs on the S&P 500, just a little bit softer. We're down here by 1/3%. Under surveillance this morning, calm before the election storm.
Very consequential, I think, particularly around trade. On the fiscal side, probably, if it's going to be divided Congress, you're going to have ongoing, very high deficits, regardless of the outcome of the election. But the trade part of this, the risks around the global trade war, domestic impact in the US and the international impact does affect, everything.
So here's the latest. Global finance ministers gathering in D.C. as the IMF's full meeting kicks off today. Foreign leaders bracing for the outcome of next month's election. Nela Richardson of ADP saying the U.S. economy in particular is still on stable ground, writing the last 5 years have primed us for jump scares and drama when it comes to the economy. As we enter the last 3 months of the year, reality is a lot less exciting. The economy is on a steady march, refusing to be tripped up by even remarkable events. Nela joins us now for more. Nela, good morning to you.
Good morning.
Where does that boring stability come from? What's leading to it?
Everything. If you look at the labor market, it's stable. If you look at business investment and corporate profits, they are drama-free. If you look at the consumer, they're spending like normal. If you look at every sector of the economy, maybe save manufacturing, the economy is performing as it normally would. And that's really important now because inflation is still too high. That's one reason. But the second reason is there's still a big segment of consumers who had negative real earnings for a very long time. And they're just getting back. And that's why, despite a very boring, pretty solid economy, consumer sentiment is so bad.
One reason why people don't like boring is because it doesn't last. And there typically is a pivot point in there where things get too hot or too cold, especially at a time where we don't understand what the neutral rate is. How do you understand how close we are to a pivot point one way or another?
Well, the first place I look is the labor market. So I'm kind of talking my book here. I have a lot of labor market data. I'm going to say that freely. Like, I admit
please.
that.
Okay.
I'm basing it on the fact that, I have a data set at ADP that's 20 million workers or 25 million. So when I look at the stability of wage gains, I see an economy that continues to hire a little bit better than it did a few months ago, but not the surge in hiring that you might expect after you look at that September jobs report, which was the most exciting data point probably of the year. But even if you look at other indicators of the labor market, if you look at initial jobless claims, after those back-to-back hurricanes, we saw them tip up. Now they're on their way back. If you look at the stable pay insights data that ADP produces, very, very moderate gains. So adding the labor market all together with pretty normal unemployment rate, you see an economy that continues to march along just fine.
I guess another way to put this is during the pandemic, the balance of leverage seemed to shift to the workers from the employers, this idea that they could demand more. Where is that balance of leverage now at a time where we're waiting for the Boeing strikers to vote on whether they will agree to end the strike on Wednesday?
That balance has shifted back to the employer, in my view. You see, first of all, that workers are not leaving at the same rate they did before. The quits rate is down. People are not turning over as quickly. If you talk to any company, they're saying that people are staying put. And when people don't move, that means that the employer has the advantage. We see it in our difference between job changers and job payers. That growth has narrowed. These other strikes, I think they are also strikes not about the present, but about the future. You see underpinning all of these is something about AI. And so really workers are trying to position for the present and for how their jobs might change in the future all at once.
We saw that in the ports as well, with those workers concerned about that. You talk about in your research, it shows that employee sentiment dipped in October. Are basically people just boring and chugging along because they're waiting for big outcomes like the U.S. election? Are people on the sidelines?
There is a hesitancy, I think, in terms of making a move. And you see that typically in election years, but this one, since it's so close to call, I think there is a hesitancy for employers and for consumers, but also it's the Federal Reserve. There's a hesitancy there. People are waiting to make big decisions, and we'll see that in the durable goods, these expensive big ticket items that you might have to get a loan for or put on your credit card. People are hesitating to see where interest rates are going to go. And so there is not just domestically, globally, reasons for uncertainty. Getting back to your point that, when things are boring, people don't trust it as much. You're waiting for the other shoe to drop, and I think that's pretty true of this economy as well.
You can sense the anxiety at the moment. Nela, it's good to see you. As always, thank you. Nela Richardson there of ADP. Up next on the programme, Stuart Kaiser of Citi, Adam Posen of the Peterson Institute, Javier Blas of Bloomberg Opinion, and we'll catch up with Thierry Wizman of Macquarie. Live from New York, the second hour of Bloomberg Surveillance. Up next.
What's really, truly in the driving seat is the fact that the economy is resilient.
The scenario that we still have in our outlook and what we discussed is a plausible re-acceleration in the economy.
The Fed needs to continue to move cautiously.
I absolutely would not rule out 50 basis points for December.
The Fed's job is not yet done.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures pulling back from all-time highs. On the S&P 500, futures negative by 1/3%. No real drama here. Around session lows. On the Nasdaq 100, we look like this. We're down 0.5%. On the Russell, we're down 1/3. The data has been much better than expected over the last week. Jobless claims, retail sales with a big upside surprise through last week's trading sessions. And then this week, things get a little bit quieter. You've got a beige book, got IMF World Bank meetings, some new sentiment on Friday. Earnings pick up a little bit with GM and Tesla. It's the calm before a very, very busy few weeks with payrolls a few Fridays away, an election on November 5th, and then a Federal Reserve decision on the 7th.
I love it. A calmer week. You've got the beige book. What else do I have to say? I'm leading off with the beige book, but you are correct. It is the calm before the storm, which is the reason why, even amid all the good economic news and earnings that actually are supportive of strength, at least in the near term, there's a real question about how durable it is. And that's the nervousness that you're seeing in the market. That's the nervousness that you really heard in a lot of the commentary over the weekend.
Good news is good news until 450, 475. Not just mentioning random in numbers. I'm looking at the 10-year. Yields right now at 412. At what point does good news become bad news for this equity market?
We have no idea, but people are talking about 5% 10-year yields over a T. Rowe Price. And you have to imagine that there is expected volatility in the bond market on the heels of the election. And at what point does that crimp some of the returns in equity markets? Goldman Sachs' David Kostin talking about for the next decade, you could see 3% annualized returns in the S&P 500 because people are going into things like bonds instead for returns. Do you get those kinds of discussions once again as yields continue to climb?
T. Rowe Price was talking about this 5% threshold in the next 6 months. They're saying debt costs are rising. What did we learn just a few days ago? The U.S. government's budget deficit hit its highest since the COVID pandemic in 2024, propelled by increased debt interest costs and higher Social Security and defense spending. And guess what? Regardless of who wins, regardless of the composition of Congress, the spending will continue.
Crude is bouncing back as well, encouraging that shift higher in yields. We're up by 2% on WTI, $70.75. On Brent crude, $74.39, up by 1.8%. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, with stocks coming off their 47th record high so far this year. Adam Posen of the Peterson Institute on what he calls the dangers of Trump's economic plans, and Bloomberg's Javier Blas with oil rebounding as investors await Israel's next move. We begin this hour with stocks on the longest weekly winning streak of the year so far, following a week full of better than expected economic data. Citi Stuart Kaiser saying solid economic data, claims, retail sales continues to improve risk reward for equity markets and smooth the runway until election day. Stuart joins us now for more. Stu, good morning.
Good morning.
That's a pretty small window, just the next couple of weeks. Then does it get difficult? It gets messy?
It could. I mean, as you mentioned, you've got those three big events in a 5-day period. Update on the economy, update on policy, and update on, I guess, politics. So, yeah, it could get a little messy. And our sense from investors is, a common refrain is I'm carrying less risk, than I otherwise would have. Just ahead of that, massive event risk, despite the positive data, I think people are kind of keeping it close to the vest.
You've been incredibly consistent. You've said repeatedly good news is good news, and Lisa and I were talking about it just briefly there. Until when? 425, 450, 475 on a 10-year? When does good news start to become a bit of a constraint for equities?
Well, look, I mean, I think it's what gets you to that 4.5 or 475. I mean, if we're printing 250K jobs and we're at 4.5, I think equity markets will be fine. I mean, if it's related to deficit spending and a buyer strike or something like that, then that's bad news, to begin with. So, I'm not going to, as you know, if we're printing strong jobs data and the market's rising on that and yields are reacting, in step, then I think we're okay. If it's coming from a third-party source or something like that, then that's a different issue.
Okay, that's a very sanguine, logical view, but we've talked about the efficacy of logic in this particular market, and you have the likes of Goldman Sachs coming out and saying, actually, valuations matter. And when you start getting real yield for bonds and you start to see those type of levels, people will start to invest in bonds for total return, for capital gains, and it will be an offset to potential stock allocations. Do you ascribe to that kind of view that essentially at a certain point, stripping out the why, stripping out the good news is good news, you're going to see some sort of penalty to stock valuations if yields go to a certain level?
I mean, no, from our perspective, I tend to live 12 months in view, and valuation isn't as big a consideration over a shorter holding period. I'm sure David and team they're obviously looking at longer dated returns. And yeah, if you're going to hold equities for 3 to 5 years, valuation matters and yields matter a little more. But look, we could have made the same argument in January. People are saying, oh, cash rates are 5%. I'm just going to sit in cash. Well, the equity market's up 20 now. So there's a logic to that. And maybe on a risk reward or Sharpe ratio basis, you would have rather been in bonds this year, though my bond colleagues tell me the volatility isn't so much fun over there either. So look, I think there's
shots fired.
Look, their volatility is impacting me personally, so it's a little painful. But no, so I would say yes, valuation matters, but for that you're talking 3 to 5 year type period. Level of yields I think matters, but it's the why. And the fact is, if you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
So we were talking about sort of the wall of worry and how it seems to be escalating in the 2 weeks ahead of this election. And one wall of worry has been fueled by this idea that there have been downgrades, revisions lower to the forward look that we've seen of some companies. It doesn't seem to worry you that much. Why?
Honestly, third and fourth quarter have kind of been revised down with the historical norm. Like consensus is usually too bullish, and that number kind of drifts lower. The number that looks high relative to history would be the 2025 numbers. So I think if companies are starting to talk about 2025 and take those numbers down, that would worry us more. And I think that's where kind of the revisions risk is for the equity market. Third and fourth quarter seem like we're going to be okay, but 2025 seems a little bit bullish right now. And if companies confirm those numbers, that was a big focus on the bank side, right? People were pushing on these banks to talk to us about 2025 and NIM and what's going on there. So yeah, I'm not as worried about this quarter, but out year is definitely looks it's a high bogey right now.
Stuart, in your note, you talk about the VIX as a 1-point election premium versus market internals, which is a bit less premium than expected. Why? We're 2 weeks out.
I think people are going to kind of getting convinced with the betting odds and things like that moving in one direction that maybe gives you a little bit more confidence that one party might win versus the other. I also think, look, if you have 4 outcomes, you have Trump, Harris, and then you have the sweeps. And I think the market is starting to basically say that blue sweep is such a low probability that you kind of take one of the options out. And I think that option is generally probably viewed as a little bit negative to markets by investors. So I think sort of taking one of them out has helped. I think, odds moving in Trump's favor has probably helped a little bit. And the fact is we're rallying, which I think is helping as well.
But do you think the financial markets are taking their cues from the betting markets? But this could be all the same people putting on the same trades, self-fulfilling prophecy.
I agree. Look, real clear, and some of the polling has also tightened up a little bit as well, right? Those are as tight as they've been probably since late July. To your point, yes, there's a lot of skepticism about what's driving, those betting odds, whether it's predicted or Polymarket. Polymarket, I think, is viewed as a little more international, and there's no limit on the size of the wager you can put on there. So Polymarket, I would take with a huge grain of salt, for that reason. But look. People believe that markets, whether it's betting markets or equity markets, is wisdom of the crowd. And if those things are moving and there's money behind it, it's not going to be ignored. Do I think people have a high degree of confidence in its predictability? I doubt that. But look, it's an input into the risk reward.
I want to talk about the wisdom of the crowds because we talk about that as trying to understand what is the Trump trade. And when you see a rally extended, how much is that because people truly expect Donald Trump to win versus some of the fundamentals we see in the earnings, et cetera? How do you parse the two?
Look, I think we're 50-50 on the election. Like I think if anybody believes they have a strong view on who's going to win, that's probably not the right place to be. And look, Trump. Look, the Trump trades. Obviously, banks is considered a Trump trade by a lot of investors. Banks have done well, but frankly, we also got banks earnings. So from our perspective. I'm a fundamentals person. I think the earnings are driving that, more than the election odds. Look, this happened in early July as well. You had, a rally in Trump trades, banks included, but at that time you also had COFR. You also had some positive news on the Basel side of things that was also driving it. So it's impossible to parse. I mean, there's no way to say the markets are pricing an X% of a Trump victory, but. If you want to believe it, then you're gonna use the sort of price action in your favor, I guess.
Just a few words on the earnings. As we often say on this program, we all say you can learn something about the earnings and how the market responds to the earnings. What have we learned about how the market's responded to the incoming earnings over the last few weeks?
I mean, I think a couple things. One, on the bank side of things, I think expectations were low. In line was good enough, and I think we saw that play out in the banks. Banks EPS for the quarter has been revised up about 1.5%. On the S&P side, I think what you're seeing is the bar isn't particularly high, right? I mean, the quarterly S&P number has been revised down about 1% in the last 2 weeks, and equities have done fine. So I think those two things are telling you bar was a little bit lower this time. If you put up inline numbers, it's a positive. That said, there's not a lot of macro events this week. There is a lot of earnings this week, particularly on the 24th, and that's ultimately going to be the real test for the market. How does that large cap tech print? And then to your point, how does the market actually trade that number?
You said that it was important to understand not necessarily third and fourth quarters, but what's going to happen in 2025. What will it do to earnings, or what will it do to the response in stock prices if we have no visibility into 2025? And frankly, corporate executives are saying that's a crapshoot.
Yeah, look, I think if there's a lot of uncertainty about that 2025 number, that should add risk premium into the market. And I'm not saying equities will trade lower, but it should create a little bit of more friction to the upside. If that's happening too, and look, I think the market is going to reorient it back to the economy and say, if we're not really sure about corporate earnings, then we need to look at the economic data. If the economic data is strong, we're going to translate that through into a solid sort of corporate earnings season. And if not, we're going to get a bit worried. So look, if the micro is murky, we're going to focus on the macro. But to your point, if the micro is murky, then there should be a little bit more risk premium on those stocks, and that should be a little bit of a headwind to upside.
It feels like we're in this positive virtuous cycle. Equities are high because earnings are good, spreads are tight, the outlook improves. The outlook improves, earnings are good, equities are higher, spreads are tight, and then the outlook improves. What's going to disrupt that in the coming months?
Well, this is the reason why people are talking about geopolitics. And I think that you underscored a point that after the election, regardless of who wins, there's going to be a vacuum of power. And there's going to be the potential for a whole host of different geopolitical hotspots. Look, I can raise all these worries. People are going to say, okay, nervous Nelly, what else are you worried about today? But the bottom line is, this is the reason why on the margins you are hearing people sound caution, at least on the surface, but then buy stocks.
Cheat guide. The list is always long for Bramo.
100%.
Very long. Stuart, good to see you. Thank you. Stuart Kaiser there. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Famed short seller Carson Block shared his bullish outlook for the biggest U.S. stocks on Bloomberg earlier today.
There's a Fed put. There's always a Fed put. Does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much, just close your eyes and buy, probably Mag 7.
Despite recent stimulus, the Muddy Waters Capital founder also went on to reiterate his aversion to China, a market that he's been calling uninvestable. Donald Trump's trade policies will do major damage to the economy if he's re-elected. Former New York Fed President Bill Dudley, writing for Bloomberg Opinion, saying that the former president's trade policies didn't do too much damage in his first term, but they will if he wins in November. Dudley writing, higher tariffs would raise both inflation and hurt growth. The New York Liberty have won their first WNBA championship. They beat the Minnesota Lynx 67-62 in overtime of Game 5 of the finals last night. This was the Liberty's sixth trip to the finals, losing each one, including last season. The Lynx were trying for a record fifth WNBA title, breaking a tie with the Seattle Storm and Houston Comets. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, Donald Trump's favorite word.
If these companies don't make their cars and products here, then they will pay a tariff, a very stiff tariff, when they send their products into the United States. We're going to call this policy Build It in America Plan.
That conversation up next, live from New York City this morning. Good morning. Equities down by a third of 1%. Yields a bit higher, up by 4 basis points. The 10-year 4.1243. Under surveillance this morning, Donald Trump's favorite word.
If these companies don't make their cars and products here, then they will pay a tariff, a very stiff tariff, when they send their products into the United States. We're going to call this policy Build It in America Plan. We brought the rate down, and you saw this, from close to 40% to 21%. Now we're going to get it down to 15%, but only if they build it in America.
So here's the latest. Global markets bracing for Donald Trump's plans to overhaul the U.S. economy through steep tariffs and big tax cuts, including cutting the corporate tax rate to 15%. Adam Posen of the Peterson Institute issuing a word of caution, writing, the Trump approach weaponizes uncertainty. But uncertainty is a difficult weapon to control, and it will backfire on whoever wields it too widely. Adam joins us now for more. Adam, welcome back to the programme, sir. Always important to spend some time with you and think through some of these issues. Let's just talk about that quote a little bit more. What do you mean when you say it's a difficult weapon to control and will backfire on whoever wields it too widely?
Thank you, John, for having me back on surveillance. I think the issue is that you do two things that don't necessarily work in economics when you threaten a lot, but it also is harmful to you. The first is you create uncertainty not just in the minds of that corporate CEO or that particular government you're negotiating with. You create uncertainty ripple effects throughout a whole bunch of other governments, a whole bunch of other companies, and they start to self-insure. They don't just get scared to do what you want them to say. They don't necessarily do what you want them to do. The second problem of this uncertainty weaponization that Trump is big on, or at least is one way of rationalizing Trump's policies, is that you actually have to implement it to be credible. You can't just threaten it. So a lot of people talking in the markets, a lot of pundits, a lot of people even affiliated with the campaign say, well, this is all just about a negotiating position. Trump will threaten these tariffs, Trump will threaten these taxes, and that will induce the reshoring to the U.S. But you can't do that unless it's credible you're actually going to do it. And the only way to do that is to actually implement the policies. So you get the harm up front and you don't necessarily get the benefit. One of the ironies, John, for people you and I and others on this program talk about is that the more the markets bet that Trump, A, will win, but B, will not actually do these crazy things, the more it is incumbent upon him to have to do them.
But Adam, when you hear from some Trump economic advisors, what they say is that it will be used as a carrot and stick approach, meaning maybe 2.5% of the 60% they want to do on China, but 2.5% every month until they get Xi Jinping to the table. Because what they say is that there needs to be fair trade between China and the United States, and they do not view trade right now between China and the United States as fair. Do you view trade right now, what China is doing, as fair?
No, but I also don't view it as something you whine about. I mean, this is the thing that both the Biden team and the Trump team have done, is if they had been Georgia playing against Texas, the top two in the football, the college football, they would have spent their whole time whining about the referees, and when a call went against them or the crowd went against them, they would have packed it up and gone home. That's what they're doing. They're packing it up and going home. But real players in the major leagues, which the U.S. economy should be, if you have to win, you win even if the referees are skewed against you, even if the crowd's rooting against you. You don't get so caught up in excuses and small deterrents.
Okay, Adam, but the Biden administration kept
trade is too small. Sorry.
The Biden administration kept those tariffs on. So what would you? Yeah. What would be your idea for both of these campaigns to try to level the playing field?
Well, but I think the point is the Biden administration and the Trump administration kept on those tariffs, and it's had absolutely no effect. The so-called phase one tariffs on China deal, which Trump had no effect in terms of what they were buying or selling. Both the Biden and the Trump administrations claim the Chinese are still stealing IP, still subsidizing, still doing this and that. So you can say, oh, well, then if this didn't work, let's try it tenfold. But that's the key difference here, is that Trump this time is talking repeatedly on the record in the platform about doing tariffs at 10 to 20 times the level he did last time, and doing them across a whole range of countries, not just China, at a much higher level. At China, he's talking about multiple fold. And so it's going to have much worse effects on the U.S. economy. You can shrug it off. It's not good. It's a tax on people. Companies that were affected by the tariffs lost valuation, as the New York Fed study showed. It was inflationary for people. But the big thing is Harris has at least said repeatedly, Vice President Harris has at least said repeatedly, tariffs are a tax. They're a regressive tax that hurt working people more, which is full on true. And she's not going to do across-the-board tariffs. I'd still wish she, in her administration, if they're in, reconsider this whole approach. But nonetheless, there's a very big difference between stopping the tariffs where they are now and only using them in specific cases at China, which is bad but minor, versus across the board, huge tariffs.
There's a bigger question here, Adam, and this is the reason why the whole concept of tariffs has been resonating with a lot of people, which is there are whole swaths of the U.S. economy that feel left behind by globalization, by moving manufacturing overseas, and would welcome the manufacturing and some of the industrial prowess to come back to the United States. Is there a proposal to increase production in the United States in a sustainable way with the staff that we currently have?
I think the answer, Lisa, is no. I mean, I might push back at you at that political perception because it's not really grounded in reality, but certainly there are people who are obsessed with having domestic manufacturing. And we have manufacturing. You know, you talk about Apple, you talk about NVIDIA, you talk about all these companies that are worth much, much more, as somebody tweeted this morning, than the companies that make stuff. You know, these are the companies that design stuff, that do R&D. And so then you can say, well, what about the terrible things that are happening? There aren't that many terrible things that are happening. We have the highest labor force participation rate in forever. We have one of the lowest unemployment rates in forever. We have income growth much higher than it's been. We have fewer people in poverty than it's ever been. So this constant refrain that we're losing because our manufacturing has moved up and up and up in value and become more productive and therefore needs less workers on the floor is falsehood. So then you say, okay, but how do we buy off the angry people? Well, that's how you get Trump. And that's not good. And so at some point you have to appeal to people that they maybe shouldn't be so angry or that they maybe should adjust. And the reality is we can't drive the entire country about what's happened in a few counties and a few states. I mean, that's part of our politics, that year after year, a majority of the country clearly has views on whether it's gun control or globalization or the economy or healthcare, and it gets stymied by very small groups.
Adam, where does national security fall into this at a time where an increasing number of the goods that we're talking about could potentially have some national security components?
That's a much more serious issue, Lisa, and that's the one which is genuinely difficult and people are wrestling with. I mean, you can imagine, it seems a bit of a stretch, but you can imagine, for example, if we do buy Chinese EVs, that there would be planted bugs and controls and things in there that could be dangerous. Not clear what the economic response, however, is the way to get around it. That doesn't mean you should let everything in. But we see right now, there's news reports now about all these weapons that the Russians are using, all these things that the Chinese are using, where you can see that ASML, TSMC, all these companies that we're protecting are still selling and producing in China. So, and that's in the very narrow spectrum of focusing on just the chips and just these critical industries with the full weight of the US government and allies, and you still can't maintain the sanctions and the controls. So again, it's like the tariffs. You just keep upping and upping and upping it, saying, well, we didn't try hard enough?
Yeah.
Or do you rethink?
Adam, it's a tough spot. A conversation you and I will continue. We'll all continue with you through to election day and beyond. Adam Posen there at the Peterson Institute. I want to mention a data point that I think is at the heart of all of this. If you go back to 1995, China's share of global manufacturing exports, 3%. 25 years later, north of 20%. And a lot of towns, a lot of communities in the Western world left behind as that manufacturing shifted abroad. And where we're at right now is what Donald Trump ultimately displayed back in 2016, that this is how you win elections. This is how it's done. And what we've seen develop since thereafter is the spread between sound economic policy and the kind of policies that win you elections getting ever wider. So you can have conversations like this with economists. Adam can make really fantastic points on the matter. But as far as politicians are concerned, these are the policies they believe they need to convey to the electorate to win elections. And until we do something about that, then ultimately this is the path forward.
And it is the swing states that have seen a lot of these areas hollowed out and really become the main areas that determine elections for the entire country.
Up next on the programme, we'll catch up with Bloomberg's Javier Blas as oil rebounds with traders tracking supply risk in the Middle East. Brent 74, WTI back in the 70s. Coming into Monday on the longest weekly winning streak of the year so far on the S&P 500, we just had week 6. As we open up week 7, we're negative by about 1/3% on the S&P, just a little bit softer on the Nasdaq 100, down by 0.6%. Earnings season ramping up through the week. GM and Tesla, 2 to watch.
To me, that's actually possibly the highlight of the week in an otherwise data light week, unless you consider the beige book a highlight, which I think it should be. But really, to me, a key question here about competition from China and the delta, the difference between U.S. car manufacturers and what we've seen out of Europe that have really been hammered in both expectations and sales forecasts going forward.
We've had a few analysts come on this program and point out the same thing, that we had downgrades to the outlook. Stellantis, we heard from VW, we heard, I think, from BMW, the same story.
Same story.
Hasn't been great for others either. A GM and Ford going to follow suit with the same story.
There is an understanding, and frankly, we've seen this in recent earnings, that they have actually diverged meaningfully because they have a solid buyer base in the United States. You don't have Chinese cars coming into the United States. And frankly, their sales in China are not as big of a component as they are among European auto manufacturers. Not to mention the fact that the likes of GM have done very well with both hybrids as well as combustible engine cars and trucks, which seem to be a mainstay for Americans.
I'm thinking of Jay Pulaski and Pulaski's Tripolar World. 3 very different auto markets. And we've talked about this a few times on Bloomberg Surveillance, that this is the direction of travel. We're going to have 3 separate islands that don't really interact with one another, and auto plants in one place to produce for one, auto plants in another one to produce in another.
It seems as though in this tripolar setup, the United States is further along in terms of the isolation. Maybe it's geographic, but in terms of the supply chain as well, than, say, Europe, which hasn't come up with that framework perfectly yet for exactly how that will look.
I have a long-term question for the auto industry, which is, if the world really does move to EVs tangibly in the future, what does China do next? They have the raw materials and they have the processing, about 80 to 90% of the entire production. At what point does China say, you want an electric vehicle or you want the battery for the electric vehicle? You cannot just buy the battery, you have to buy the car.
This is what the tension could look like in the coming years. That's the equity market. Here's the bond market. 2-year yields look like this. They're up and away by 3 basis points, 3.98, just short of 4%. We're up 4 basis points on a 10-year, 4.1282. Yields the highest since July 30th of this year. So you've got to go deep into the summer to see yields this high earlier this year. A question about what's driving this. Is it the economic data or is it the politics? Is it the politics? And I think Stuart Kaiser did a decent job of this a little bit earlier from Citi. Stu said it's not so much about a red wave. It's about taking away another scenario. It's taking the scenario away that is a blue wave. People really reducing the probability that could take place, evolve, materialize in the next few weeks.
And that's the reason why he said volatility had come down and marginally, but you haven't necessarily seen the volatility go down dramatically when it comes to the bond markets, because there is this possibility, if you get a red sweep, that could potentially, under certain economic scenarios, cause the deficit to increase more, as any sweep would, and thus cause some sort of extra premium to be baked into the Treasury market.
This story of high yields in America fueling some dollar strength for a 3rd consecutive week. That is the longest weekly winning streak for the US dollar against the euro, going back to June of this year. If you look at the euro right now at 108.51, it's negative once more by 0.1%. I think this sets the stage for the IMF World Bank fall meetings this week, just how different the outlook is for America versus the rest of the world.
And exactly what is the approach that lawmakers take and policymakers take, especially as the heads of finance ministries come together? Do they talk about borrowing more money to support industries, or do they talk about the idea of fiscal restraint and the woes of the deficit of the United States and how that could cause a problem and how it's important to bring your deficit down? If they talk like that, a lot of people will be nodding their heads, but it is not necessarily a good sign for the European region, which might need more of a cash infusion than, say, fiscal restraint.
The euro at 108.51. Under surveillance this morning, Southwest Airlines and activist investor Elliott Management may finally be heading towards a truce. Sources telling us here at Bloomberg that both sides have been discussing a potential settlement that would avoid a proxy fight for control of the airline's board. Lisa, that stock is down 1.3%.
So basically, it looks like they have a stock buyback plan. They're going to keep the CEO. They kicked out the chairman. Either way, Southwest shares are up 7% so far this year, which would be the first annual gain going back to 2019. There is a feeling that this company has underperformed, even at a time when people have been talking about how low-cost airlines in general have been seriously challenged.
On top of this, we've seen Southwest come out and make these policy changes and these tweaks to not just revitalize the company, but also try to fend off Elliott. I have to say, at the end of the day, I think the consumer might win from this. Southwest will begin selling assigned seats late next year, introduce a premium fare option offering extra legroom. So if you want to get maybe a little bit of a cheaper airline price ticket, but not terrible service or terrible legroom, they're doing some due diligence.
Who paid for this spot?
There's a big reason that there's an activist investor on board, because everything you just said could have been said 5 years ago. They're so late to this story.
Honestly, you need to get fees. Otherwise, you're going to have a hard time. You need to become a credit card company and just sell all the extras, sell the oxygen that you have to breathe. I'm waiting for that to happen because I remember flying Frontier and they said, do you want a drink? Okay, that's going to be $3. And that was a bribe for my kids.
About to say they're about to start selling oxygen over at Frontier.
Well, you never know.
Pretty close to it. Let's get you an update on politics. Kamala Harris saying Donald Trump's lack of decorum will disqualify him from some voters. Harris telling Reverend Al Sharpton of MSNBC, the US president's, quote, walk into rooms around the world with the earned and self-appointed authority to talk about democracy and the rule of law. He's not earned that right, and that's why he's going to lose.
She's going after some of the things he said on the campaign trail this weekend. Some of them were inappropriate. I'm not even going to repeat them. Not just about calling her out, but also former pro golfers, etc. This might not land for some people, but it could land for others. The issue is, obviously, 2 weeks to the election, they're all going to be giving it everything they have. Where are they today? Trump is going to be in North Carolina, wanting to make sure that state that notoriously goes red stays with him. And where is she? She's going to every single blue wall today. Pennsylvania, Michigan, and Wisconsin.
So we leave the golfer comments to one side. Pretty strange over the weekend. Let's get you an update. I'm not going there. An update on the Middle East.
Want to.
Hezbollah attempting to attack Prime Minister Benjamin Netanyahu's home north of Tel Aviv. No one was injured, but Netanyahu's saying it's another reason retaliation against Iran is warranted. Israel still drilling down on plans for an assault against Iran 3 weeks after a ballistic missile attack.
So what I find interesting is that today we are going to see Secretary of State Antony Blinken going to the region. His 11th trip since the October 7th terrorist attack. Why is he going now? I really do think this is the United States making sure they get him in the region. You have Lebanese reporters talking about the fact that Amos Hochstein is also in the region in Lebanon. They want to get these U.S. officials in the region. Why? It buys them time. If you have the Secretary of State in the region, you cannot be Israel and then have a massive retaliation against Iran at the same exact time.
Part of the reason crude is up this morning by 2%, WTI $70.80. Crude rebounding after falling close to 8% last week, with traders keeping an eye on supply risk as Israel continues to weigh retaliation against Iran. Other headwinds including signs of soft landing in China as banks there cut lending rates. Bloomberg's Javier Blas joins us now for more. Javier, welcome to the programme, sir. We're going to be talking about coal. We'll talk about gold as well. I want to start with oil. You wrote a number of weeks ago that the risk of falling to 50 might be greater than the risk of rallying to 100. Has your view changed, Javier?
No, it has not changed. And mathematically, and I know this is a bit of a red herring, but mathematically, with Brent and WTI trading between $70 and $75 a barrel, we are closer to 50 than we are closer to $100. I believe that Israel has put aside his initial intention to retaliate against Iranian oil installations, and therefore we have removed a chunk of the geopolitical risk. The focus is still on 2025, more OPEC crude coming into the market, soft demand growth next year, and an oversupply market that doesn't require prices close to $100 oil.
Javier, when you look at the fundamentals of this story, we have Amin Nasser basically today talking about the fact that he's bullish on China. Do you see that demand pick up in China?
Amin Nasser is a seller of oil and one of the world's largest sellers. So he also always bullish about China. I don't think that the global oil demand is as weak as some people say. We are growing still around 1 million barrels a day, and that is quite remarkable considering all the amount of electric vehicles and energy efficiency that we are introducing in the global economy. But at the end of the day, the big problem is that OPEC bringing extra barrels into the market, the non-OPEC supply led by the United States, but not alone. Brazil, Canada, Guyana, other places, more oil coming into the market. At the end of the day, this is not just a question about whether China is strong, it's also a question about supply. You could have very strong demand and very strong supply and therefore an oversupply market. And I think that when you put all together for 2025, we are going to have more oil that we are going to consume. Therefore, prices will need to be a bit weaker.
Okay, but let's look at the short term again and just look at the geopolitics of what's playing out. Do you think the market right now is pricing in enough the potential for an extended or war we are seeing right now in the Gulf?
No, the market is not pricing a significant disruption in Middle East oil supply. If we were to have a significant disruption in Middle East supply, say that we were to lose all the Iranian oil supply and perhaps oil from other countries in the region, say Saudi Arabia, the United Arab Emirates, Kuwait, we will have much higher prices. The market is not there, and I don't think that the risk is as elevated as some of the bulls try to paint. But yes, I do agree that if we lose a significant chunk of oil, then prices need to go much higher. That is not price.
How much is gold a geopolitical play versus a completely separate story entirely?
To me, it's a complete separate story. The main drivers is too much public debt around the world, high fiscal deficits, with some countries running based on a GDP fiscal deficits that look more like we are fighting a war with countries that they are not fighting wars at the moment. So yes, there is an element every time that there is tension in the Middle East, there is gold, that's the safety, but I do think it's mostly a financial play, a fiscal and public debt. And the meetings this week in Washington of the International Monetary Fund and the World Bank are going to be having a big focus on public debt, and I think that probably is positive for gold.
There's a sort of larger takeaway here where we talk about what's influencing, what's sort of the geopolitical hedge, what's sort of the idea of the supply-demand dynamic, given how much transition there has been to a number of electric vehicles in places like China. It raises the question of increased demand for what, right? How much oil are they actually going to use? What is the commodity that you look to really understand consumer appetite? You start to see it pick up, or sort of the most leverage to an increase of activity around the world? Is it still oil?
Oil still gives you a very good, clear indication of where the global economy is heading. And you could drill down in subcomponents of oil. I would say diesel is really the key component of the global economy. That is today where the weakness is in China. There's a lot of talk about gasoline demand being weak because electric vehicles penetration in China and other places. But really, the refined petroleum product that has been weaker relative to what the expectation was has been diesel. And that's manufacturing, that's construction activity, generally transportation of goods.
Javier, when you're talking about AI demand, everyone's going in for electricity, this consumption. You have a great piece out this morning talking about the fact that coal is not going away and actually is the driver of this transition. Are we at peak coal, or potentially could this even go higher?
We have been talking about peak oil since, if I remember correctly, around 2013. And it was always said that peak coal was going to be reached in the next couple of years. So in 2013, we say it was in 2015. 2015, it was 2017, and so on and so forth. And we are not there yet. Global demand for coal in 2024 is going to be at an all-time high. I believe that next year will be very similar. So we don't have yet peak. And also, the word peak to me is the wrong one. You are a mountaineer, you like a bit of trekking. When you talk about peak, you reach the summit of a mountain, and what it comes after the climb is a very rapid descent. It's just the going up and the going down is very similar. And here, when we talk about peak, is we reach the summit and we stay there on a very high altitude plateau, and that's not what a lot of the net zero by 2050 scenarios say. And we need a peak followed by a rapid decline, almost a cliff. That's not happening.
How much are people looking at the AI adoption and how much that's going to really increase demand when they start looking at things like coal usage, when they start looking at what gasoline demand could look like going forward?
If you look at what the electricity consumption in the next, say, 7 years, 6 years from now until 2030 is coming from, AI is going to be playing a role alongside data centers, but it's very similar in terms of size for what we know today to the incremental need for desalination of water. the biggest drivers of electricity demand in the next, to the end of this decade, to 2030, are going to be coming from the industry, where the industry continues to electrify, moving away from natural gas and petroleum into electricity. It's going to be coming onto electric vehicles. And the other big chunk is going to be on air conditioning. The needs for cooling, the needs for air conditioning in the world are absolutely skyrocketing. And that's a combination of climate change, hotter weather, but it's also a combination that a lot of the population in countries where the summers are really hot are getting wealthier, and they are reaching the GDP per capita that is traditionally associated with the first purchase of an air conditioning unit. And that is what is happening across large swatches of North Africa, Southwest Asia, places like Pakistan, India, etc., etc. And that's where the electricity is going to be coming in. Artificial intelligence, yes, I'm just trying to be nice to artificial intelligence, is the kind of sexy new thing in the energy transition, but it is not the thing. Desalinization is going to be as important. Very few people talking about that part of the electricity consumption.
Interesting. Javier, this was just a brilliant piece. Enjoyed reading it. Javier Blas there of Bloomberg Opinion. You can find that column on Bloomberg.com and on the Bloomberg terminal. Here's a few paragraphs that jumped out for me. The International Energy Agency published its annual World Energy Outlook. Buried in the 398-page report was a warning. And here's the quote. The outlook for coal has been revised upwards, particularly for the coming decade, principally as a result of updated electricity demand projections, notably from China and in India. And here's the number for you. It wasn't a small revision. Javier writes, coal consumption in 2030 is now estimated to be 6% higher than only a year ago.
So how is that transition to clean energy going? This is the quintessential dirty energy source, and yet this is sort of one of the necessary components to adapting to a very new world.
This is why there's tons of criticism on the clean energy transition, especially looking at these cheap EVs coming out of China. That actual EV may be better for the planet, but how it got to be made, these negative externalities on the transition. You know what else I thought of when Javier's talking about not this peak, but this plateau? Remember in the debate when Donald Trump went after Germany and how they had to revive, quote unquote, normal energy? Germany came back with a response, but their response in itself actually proved Trump's point. Germany said, I just pulled it up, coal will be off the grid by 2038 at the latest. 2038. That was their response.
It's the dirty secret in the energy transition. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs says the S&P 500's decade of big gains is about to come to an end. David Kostin and team said that the U.S. stocks are unlikely to sustain their above-average performance and that investors will turn to other assets like bonds for better returns. Kostin predicts the S&P 500 will post an annualized nominal total return of just 3% over the next 10 years. That compares with 13% in the last decade and a long-term average of 11%. Boeing shares higher in the pre-market trade, up 3%. It reached a tentative deal with its largest union to bump employee pay by 35% over 4 years. Workers vote on Wednesday to end the 5-week strike. That happens also to be the same day of Boeing's third quarter earnings, and it will be CEO Kelly Ortberg's first. However, hourly workers have yet to sign off on the agreement. Union negotiators are not endorsing the proposal. The Kansas City Chiefs are the NFL's last undefeated team after taking down the 49ers in overtime in a rematch of last year's Super Bowl. The game saw no touchdown passes and 5 combined interceptions between Pat Mahomes and Brock Purdy. Elsewhere, the woes are deepening for the Jets after falling to the Pittsburgh Steelers on Sunday night. Donald Trump was among those in attendance, making a campaign stop and leading some fans in a USA chant. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the US in a driver's seat.
The world's savings have gone to the United States. What we are now is, I think, the market completely wrong-footed by the US economy.
That conversation up next. Stocks just a little bit softer. We're down 1/3% on the S&P 500. Under surveillance this morning, the US in a driver's seat.
The capital inflows from everybody sucked in by US yield, by US tech stocks, by US exceptionalism, US outperformance overall, over the last couple of years. So, the world's savings have gone to the United States. I think we have to clean out some of the positioning at some point and get a more meaningful dollar sell-off before the U.S. economic outperformance can drive us lower. What we are now is, I think, the market completely wrong-footed by the U.S. economy.
The US dollar on the longest winning weekly run since June. Thierry Wizman of Macquarie suggesting recent strength has two pillars: American exceptionalism and the Trump trade. The first has been attested to in more hawkish US data, stronger activity, less disinflation versus the rest of the world. The second found its support in Donald Trump's rising probability of winning the US election. So long as they persist, the dollar can strengthen. Terry joins us now for more. Terry, good morning.
Good morning, John.
So that's the big if at the end there. Can they persist? Which one is more durable?
Well, we don't know who's going to win this election. And I think regardless of who wins this election, American exceptionalism will continue at least a little longer, in the data certainly. There is a catch, though, and the catch is, what if we have an election? And forget about who wins for a moment, but that election is contested, and people start to question American institutions, specifically election and political institutions, and legal institutions as well, because we know there'll be a lot of lawfare involved in any contesting of the result of this election. That's where we might start to get fragility in the American exceptionalism story, and that's how the American exceptionalism story is linked to the election. But until then, they're really two separate issues, and they can run independently. Clearly, if Trump wins and we don't have a contested election, then we'll have a Trump trade, and we'll have American exceptionalism running at the same time. That's the better scenario for the dollar, obviously.
Just how much upside could there be in that scenario?
Well, our own projections have the euro-dollar FX rate going down to 105 if Trump wins. We have dollar yuan in China going up to 740. It's clearly a strong dollar story that continues from these levels if Trump wins.
So you're talking about a contested election. At the same time, people are talking about election week, not necessarily election day, or perhaps election 2 weeks or 3. At what point does it become a problem for the dollar? At what point, as it grinds on, as ballots are counted and people kind of try to determine and recount again?
Yeah, so if you go back to the 2020 election, I believe that there were some states that had not resolved their final counts for 4 days or 5 days. Now, that didn't mean that we didn't know who was going to win, because maybe those states didn't matter in view of the counts that we got from other states that were deterministic in favor of President Joe Biden. But I think that's a good benchmark, right? If we have a situation where states that happen to be decisive for the election are going on beyond 3 or 4 days, then I think we start to see fragility in this market.
If there's a contested election, do people buy the dollar and U.S. Treasuries because they need a safe place to go, or they're viewing the United States as not on fair footing, as a scary place potentially to invest, and they buy other things? Is that reason why maybe gold is higher?
It certainly is one of the reasons why gold is higher. I think people are trying to hedge the political uncertainty out there to some extent. And it's not just the U.S., but it's international as well. But getting back to the U.S., yes, they would buy treasuries because that is the obvious safe haven. However, I don't think that would be good for the dollar, right? I think in this context, it would be lower yields, but a weaker dollar as well. And those are completely consistent with one another if you think about it.
Terry, the one I'd worry about, and Lisa, I'm sure you feel the same way, if we wake up that morning and Treasuries sell off and the dollar does too, then we've got a problem, a big problem.
That speaks to a question of really what the underpinnings of the country is, and really goes to Terry's point about American exceptionalism and how much that gets undermined in a serious way.
Terry, it was great to see you.
My pleasure,
as always,
John.
Plenty to think about. Thank you, sir. Terry Wizman there of Macquarie. In the third hour of Bloomberg Surveillance, we'll catch up with Jim Caron of Morgan Stanley, Jason Gursky of Citi, Aditya Bhave of Bank of America, and we'll speak to Bob Elliott of Unlimited Funds. 15 days to go until Election Day, or as Lisa suggested, Election Week. Kicking off just around the corner. Equity futures on the S&P 500 just a little bit softer from New York City. This is Bloomberg.
Financial conditions are incredibly loose.
The market in fixed income is definitely volatile.
Equity volatility, for the most part, has been low.
It can look a certain way at the index level, but there's opportunity under the surface.
I don't feel bearish by any stretch, but valuations feel full.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Election day 15 days away. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now with equities pulling back from all-time highs on the S&P 500, the 47th record high of the year in Friday's session. We're down a third of 1% on the S&P this Monday morning. We're down 0.6 on the Nasdaq 100. Looking forward to a week full of earnings. The focus of our attention on the automakers in America. Tesla and GM just around the corner.
How much visibility do they have into the future at a time where you do see this increasing fissure, particularly in the European auto manufacturers? I'm also wondering, and I know this sounds like it's really peripheral, but how much they see an increase in demand because benchmark rates are going down. This is the type of sector that could get a bit of a boost from some of the interest rate cuts we've seen so far.
I'm glad you started this hour with its 15 days to the U.S. presidential election. Citigroup comes out today waiting for two risks. No, honestly, we're going to get earnings and stuff, but really we're waiting for two risks. And they say limited data out this week will keep markets focused on the two risks, the U.S. election and the upcoming jobs report. In the meantime, jobless claims and PMI will be the focus this week. But really, we heard from Nela Richardson. She's talking about the fact that it's a boring economy and there is hesitancy on the side. Why? Because people want to know the outcome of the U.S. presidential election before they start maybe moving jobs, investing more, getting M&A deals done. The list goes on.
Get that week ahead up on the screen again, because I think it all speaks to each other. The auto earnings later on this week, potentially speaking to a divide of weakness over in Europe and strength in the United States of America, a divide that the IMF World Bank full meetings will have to address. The election 15 days away, the policies that we could see implemented in the next 6 months in this country could really shake up that industry and those economies in a much bigger way.
In a way, they are the epicenter of a whole host of different things that we've been talking about, whether it's the tripolar world, as you were talking about, in terms of isolated industries that are growing up in their own, national security and questions about where some of the chips that are an increasing component of cars are, and then to the prowess of manufacturing. And as Adam Posen was saying, that has become, in some ways, one of the biggest political deciding factors at a time where a lot of the swing states tend to really be manufacturing hubs, or at least used to be once upon a time.
Every time we've gone down to these meetings, we've had this conversation. Their ability to retain and in some places regain relevancy in this conversation. The IMF and World Bank, they've lost the fight. They've lost the conversation. They've lost the battle. It is just taken as done that these tariffs are going nowhere. They're going to stay on or increase. And there's not much they can say this week that's going to change that.
This used to be a celebration of globalization. We are seeing the deconstruction of at least the concept of globalization in its heyday. And you have to wonder where these meetings, where the IMF, where the World Bank will sit with this. Do they castigate the United States for a deficit? Do they say that that's going to lead to higher borrowing costs? Do they encourage some sort of spending in a place like Europe? How do they sort of uphold some sort of order that they once had at a time where ultimately a lot of the politics coming down the pike are really going to undermine some of what they ascribe to?
Lisa heading down to the nation's capital a little bit later this week. Fantastic lineup of conversations coming up for you. We'll share them with you in the next few days. Equity futures on the S&P, a little bit softer here. We're down by a third of 1%. The opening bell about 1 hour and 26 minutes away. In the bond market, yields grinding higher. We're up by 5 basis points now, 413.22. It's not just about the economic data. We've had a range of conversations already this morning suggesting that there is a Trump trade starting to emerge in this market over the last week. You see it in equities to some extent, though I would suggest it's difficult to disentangle that away from what we've seen from, say, bank earnings. You see it in the bond market to some extent, though I would also say it's difficult to disentangle that from the strong data we've had in the last week. But certainly the bond market is one way of capturing that story.
Especially because Stuart Kaiser, I want to pick up on something that he said, that there is one scenario that is increasingly being priced out, looking more remote, which is the idea of a blue sweep. And as that becomes less realistic, you start to expect, well, on the margins, can't you imagine that yields would rise? And that's the reason why, on some level, people are saying maybe that's a component of what we're seeing in the bond market.
Mike, also this morning, Morgan Stanley, markets appear to be rotating towards the Trump win scenario. We're seeing that as well in the betting market, although there's lots of speculation. There's this whale like there was during when Romney was running, a huge whale in that betting market. One thing I will say to those that are discounting a blue sweep is what happened to the red wave that wasn't in 2022? Have people just forgotten?
In the midterms.
In the midterms.
Yields are up this morning, 5 basis points. The 10-year 4.13, the 2-year up 4 basis points, just short of 4% this morning. Coming up this hour, Jim Caron of Morgan Stanley with the S&P on the longest weekly winning streak of the year so far. Jason Gursky of Citi on why defence stocks are well positioned for growth, and Aditya Bhave of Bank of America on the case for re-acceleration. We begin this hour with stocks trading near record highs, and investors consider the prospect of a so-called no landing. Jim Caron of Morgan Stanley saying he's not bearish, but sceptical, writing this: inflation is creeping higher and puts further scrutiny on the Fed's ability to cut interest rates. Tensions in the Middle East also create a potential for a more systemic type of risk. We can't forget that a bull in a candy shop is still just a bull, and bulls can be unpredictable. Jim joins us now for more. Jim, welcome to the programme. Let's run with that analogy. A bull run, if you will. A bull in a candy shop. Do you think we're a little too high on sugar right now?
I think that's a good way to put it. I do think of it as a little bit of a sugar high. My concern is that we're pulling forward 2025 earnings right now, and we're painting an almost near perfect picture going into the future. It's not that I'm bearish. It's not that I'm negative on the markets broadly. I just think that we're getting a lot happening really, really quickly. In other words, we're getting this soft landing that everybody's been projecting, but we're getting it very, very fast. Valuations reflect that, right? So if you look at $280 earnings, let's say for 2025, which is roughly consensus, you assign a 21 or a 22 multiple to that, you're going to get an S&P somewhere close to around 6,000, and that's about where we are today. But if you take that valuation down a little bit and you get it a little bit more normalized to say maybe a 20 PE on those $280 earnings, then the S&P is 5,600, right? So it's lower than where it is today. It's not a disaster, but net, we're talking about a few percentage points in either direction. I don't necessarily think that we're going to be in a very strong bull run from these levels or from these valuations. So that's where my skepticism is. I'm not saying that things aren't okay, consumer's strong, retail sales was good, inflation, earnings, GDI numbers are all good. So incomes are good, so people can keep spending. What I'm saying is, how much can it continue at this rate of change?
Well, let's take the valuation piece of it, Jim. This is what Cameron Dawson of New Edge said over the weekend. You could have argued at any point over the last year that stocks were expensive. I'm sure you'd agree with that. But there needs to be a catalyst to change this march to ever higher multiples. It feels like, Jim, we're in this virtuous cycle right now, looking for a disruptor to it. And Torsten Slock of Apollo spoke to the same thing. The Fed's cutting rates. They've got a bias to cut even more. So we've got a dovish Fed. We've got high stocks and high home prices. Public and private financing is wide open, as you can see. Continued support from fiscal plans. Low debt servicing costs that are locked in for both corporates and households as well, Jim. That's just feeding on itself. So the outlook just keeps on improving. Now, Jim, from your perspective, do you have anything in mind that could disrupt that process at the moment? Because that's the reasons people are so bullish right now.
Yeah, and I agree with those reasons, and it's why we maintain a bullish tilt in our portfolios as well. Moving more towards neutrals, not moving towards negative, because we do think that there are some potential factors. Clearly tensions in the Middle East, a flare up there. We could get some election uncertainty or some election volatility around this. But ultimately, what we would need to see is damage done to the consumer and a rise in the unemployment rate. So I think some of the damage that could come is that if we start to see some weakening of the labor market. Now, we're not seeing signs of that yet, but we all know that the non-farm payroll data has been heavily revised over time. And if we do start to see that in a period where we start to see some margins starting to shrink across corporate America, that could create a significant or a faster move higher in the unemployment rate. And that would completely change the narrative. We're not there yet, Jonathan, and I think that's the most important thing to highlight. We're not there yet, but we do have to recognize that at these valuations and at these levels, that it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
One aspect of your argument is essentially kind of abnegating this idea of a cyclical tilt, that you can get that rotation away from big tech and some of the arch behemoth, other large stocks, and really fuel this next leg of recovery. And I saw the same kind of sentiment from Mislav Matejka over at JP Morgan. How much are you leaning against the cyclical move, the idea that the equal weight and the Russell 2000 have been outperforming?
No, actually, Lisa, I mean, I think it's a great question. And actually, we're embracing the broadening of the markets and the cyclicals and even the defensives. So what the markets are kind of realizing right now is that this Mag 7, the tech and the larger cap and the growth names that are out there have done a very, very good job this year, but there may be more to the story. And this is going to be across the Russell. This is going to be across the broader base sectors of the markets. This is going to be across the equal weight. One of the themes that we're putting forward as we move into 2025 is how do you invest in what seems to be a fully valued market? You can't really play the beta. You can't just say, oh, well, the index is going to go up another X%. More or less what you have to do is you have to start thinking about the different components of the markets. You have to find sectors in the markets that are well valued, that have lower PE multiples, good balance sheets, good factors, good interest coverage ratios, and have some pricing power and some controls. And you can find them in the other 493 stocks. And I think that's the stuff that we should be looking at. Those are the sectors, that's the management style that we need to start to move into, because I think it's going to be more about asset selection and investment selection as we move into 2025, as opposed to just a target weight asset allocation into X% equities or X% bonds. It's really going to matter how the constituency of your portfolio is made up, what sectors, where, and what valuations.
Is this a sort of 1 year time frame of an adjustment in investment cycle, or do you see this as a 10-year kind of time frame, as maybe the overall index level returns don't look as great as they have traditionally?
Yeah, I think this is something that probably adjusts over the next year or so. So let me call that short term. I don't think that we're always going to have this bifurcated market like we do today. I think there needs to be some coalescing, and that's where you get the broadening of the markets, where you get other sectors that haven't participated in the rally start to participate late. That's usually a late cycle thing to start to see. And then the markets tend to move in a more uniform way, beta up, beta down. So I don't see this necessarily as a long-term view, but I do say that 2025 will be all about tacticals. Don't forget, we're going to be talking about taxes and policy, no matter who the next president is. We're going to start talking about that on January of 2025, because that's when the decisions are going to start to get made that are going to have big influences on markets going into late 25 and into 26, when policies are likely to change.
Jim, do you believe right now that the market is rotating into the Trump trade?
Yeah, I think it is. And I think it was said, nicely by Lisa, earlier on the show, that it's in some degree, it's a movement away from the blue wave, right? So I know we've been talking about tariffs, and we call tariffs a tax, but taxes are also a tax too, right? So if one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. And ultimately, no matter who the next president is, I think it's going to be really hard to get inflation under control. And that's one of the reasons why I think you see yields starting to move higher. It's not so much just a Trump trade or not, but I think it's a realization that we're moving to an area where deficits are still going to be high. There's still a large degree of spending that's out there, and the U.S. deficit is too high, by the way. And all of this is putting upward pressure on rates. And I think this is something that we're going to have to deal with as we move into the next months ahead.
370, September 18th on a 10-year when the Fed cut 50 basis points. 370 this morning, 413. Jim, it's good to see you. As always, thank you, sir. Jim Caron there of Morgan Stanley, a 40 basis point plus move on a 10-year since the Fed started cutting.
This comes with people expecting fewer rate cuts, with better expected data, and we have seen that out of earnings, and we've seen that out of headline data. But it's also coming with this realization that regardless of who wins, deficits are going to be a bigger question mark hanging over this bond market.
Bond yields up 5 basis points this morning on a US 10-year, 413.42. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Israel launched a military operation targeting Hezbollah's economic strongholds in Lebanon. The Israeli military sought to hit targets associated with the Al-Qaeda Hassan Association, which serves as Hezbollah's alternative banking system. A senior Israeli intelligence official said that the aim is to target Hezbollah's ability to function during the current war and later as it seeks to rebuild and rearm. Elon Musk's super PAC will give away $1 million a day until the election to someone who signs a petition calling for free speech and the right to bear arms. Musk said in a post on X, his pro-Trump group called America PAC will randomly pick a registered voter in swing states to win the prize through November 5th. Pennsylvania Governor Josh Shapiro questioned the legality of the cash payments on NBC's Meet the Press, calling it deeply concerning. The U.S. Grand Prix belongs to Charles Leclerc after the Ferrari driver clinched his third F1 race of the season. The Monaco native finished the race 1-2 ahead of his teammate Carlos Sainz, but attention quickly turned to rivals Lando Norris and Max Verstappen, who were locked in a controversial finish. Norris was penalized 5 seconds for leaving the track to pass Verstappen. Verstappen ended up taking third place. And that's your brief, John.
Danny, thanks for that. Ferrari 1-2. For anyone who missed that, we'll give you a recap again in about 30 minutes' time. We won't. I might.
Okay. Is this the new thing?
What's that?
More than even football?
I squeezed that in at the end of the programme.
I know, but I'm just asking.
We
Formula One?
front-loaded baseball.
No, we're doing baseball again.
Okay, I know, but I'm just wondering, is Formula One superseding football in Fairland?
No, when Ferrari win, yes.
Okay, duly noted.
Up next on the programme, the Morning Calls Plus. Jason Gursky of Citi on why defence stocks are positioned for long-term success. That conversation up next. The opening about 1 hour and 12 minutes away. Stocks a little bit lower, down about a third of 1%. The one to watch here, bond yields up 5 basis points. The 10-year 4.1361. Time now for some morning calls. First up, Citi downgrading Caron to neutral, noting lengthy and costly turnarounds for luxury brands. Their stock is down 1.5%. Your second call from Barclays downgrading UPS to underweight, flagging long-term pressures from the possible loss of Amazon volumes and competition from FedEx. We're down almost 2% in early trading. And finally, JP Morgan downgrading Hertz to underweight, citing a long path towards normalized earnings. That name is down 4% in the pre-market. Turning to defence, the Citi Equity Research Team saying rising government spending is positioning the sector for success, writing this: we expect spending growth to favour investments in the tools of deterrence and in the restocking of the munitions used in Ukraine and the Middle East, both of which suggest the growth of weapons spending is likely to be faster than overall military expenditures across the Western world in the near to medium term. I'm pleased to say that joining us now is Jason Gursky of Citi. Jason, welcome to the programme, sir. I know you've got 3 different scenarios for spending, and maybe we should start there. Could you go through each of them for us?
Yeah, sure. And the scenarios are all kind of related to defense spending as a percentage of GDP amongst Western allies in particular. Our base case is that the recent increase in spending as a percentage of GDP as a result of the conflicts in Ukraine and the Middle East, we consolidate those and we continue to spend out into the future at current levels of GDP, which sets up the industry or military budgets to rise, roughly in the low single digits with this shift to military spending that you mentioned in your shift to weapons spending that you mentioned in your setup there, allowing for mid-single digit growth. The upside scenario would be, an unforeseen conflict that pops up, or the sense that Western allies feel even further threatened than they do today, and we end up spending more. And then the downside scenario would be a compression of spending as a percentage of GDP, as again, kind of in your earlier setup here, that deficits get in the way, and we need to make some hard choices on what we end up spending scarce resources on. But at this point, our base case is GDP spending as a percentage of GDP remains relatively flat given the threat environment, and that we see mid-single-digit growth for the weapons buying accounts, which supports the defense contractors.
Jason, do you have a sense of who potentially would want to add when it comes to the defense budget, a Kamala Harris administration or a Donald Trump 2.0?
Yeah, look, at the end of the day, spending tends to be driven by the threat environment. Western allies spend when they feel threatened. I think what we might see is maybe a little bit of a shift in the mix of spending between the two administrations. Former President Trump has been pretty vocal about his desire to wind down the conflict in Ukraine in pretty short order. The last time he was in that seat at the White House, he shifted spending towards things that fly and float to support a perceived threat out of the Asia-Pacific region and China. So I think we could see maybe a little bit of downward pressure on things that crawl on the ground or support ground conflict in Ukraine, and more upward spending on things that would support conflict in the Asia-Pacific. Whereas Harris, I think, would be a little bit more even-handed and spread spending across both regions.
Jason, what strikes me about this conversation that's so interesting is modern warfare looks sort of similar to what I think of when I think of previous warfare, crawling on the ground, flying and floating. How different are some of the equipment demands that you see now for modern warfare versus, say, 10 years ago?
Yeah, they are different, for sure. They're supporting troops on the ground, but space-based assets have become incredibly important. Space is the ultimate high ground. We can garner lots of intelligence, surveillance, and reconnaissance kinds of data from space, and that's why we've seen companies like SpaceX be so successful in the launch environment, and the Space Development Agency spend a lot of money on developing new space-based assets. So space has certainly been a change here over the last 10 or 15 years. And then attritable aircraft and UAVs have certainly popped up as something that is pretty profound change in the way the war is conducted today. So we're likely to see a lot more investments in UAVs and attritable aircraft. And we've got DoD standing up an initiative called Replicator to do just that.
How much of an upper hand does the U.S. have versus, say, Europe when it comes to some of this military expenditure and creation in some of the companies that are coming out?
Yeah, it's a good question. Prior to the Ukrainian conflict breaking out, I think our report suggests that about 60% of the military kit that the Europeans purchased actually came from U.S. suppliers. Today, it's about 80%. So the industrial base here in the United States is much bigger, much more diverse in its capability sets, and much healthier than what we've got in Europe. Mario Draghi over in Europe recently penned a report suggesting, hey, we've got to fix this over in Europe. We've got to have a better industrial base, and we need to be better coordinated. So that's probably going to be one of the interesting lessons that comes out of this, and maybe the long-term implications is that maybe Europe becomes a little bit better coordinated and stops importing as much as they do from the United States.
Jason, what I heard from a few individuals who surround the former president is that he would come into office and actually, he talked about a 2% target, definite floor for NATO. Now he's talking about NATO allies spending potentially, one thing they will do is 3% of their GDP towards defense. How much bigger can Europe continue to spend on the U.S. defense industrial base if it's the former president in office?
Yeah, that's a good question. I mean, you get down to hard choices to do that. I mean, let's first get to 2 amongst NATO countries. I mean, NATO as a whole is already there because that includes the United States. But if you're counting just the European countries, I still think we're a smidge below 2. So let's get to 2 first. But it would be a very significant increase and lead to budgets that are 8 to 10% higher for quite a few years, maybe out through the end of the decade in order to be able to get to 3% growth. Look, I think the Trump administration would continue to put pressure on the Europeans to pay their own way relative to the United States as we go to focus on Asia. It would be a big deal. It's probably a little bit harder to do in practice that quickly, given the tough choices that you would need to make either by raising taxes or cutting spending in other areas.
Jason, we've got to leave it there. We've got to catch up. Thank you, sir. Jason Gursky there of Citi. Up next on the programme, Aditya Bhave of Bank of America, Bob Elliott of Unlimited from a beautiful New York City, 80 degrees in New York today.
It feels illegal.
80.
You love it, don't you?
Absolutely love it.
Yourself.
Can't get enough of it.
I know.
Counting you down to the opening bout with equity futures just a little bit softer as they have been throughout this morning so far. We're down on the S&P 500 by, let's call it 0.25%. On the Nasdaq 100, negative by almost 0.5. 1 hour away from that cash open. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Boeing's had 5 weeks of pain and a cash burn of $1.3 billion. Looks like there's a third bite at the settlement cherry on the table. It will be put to the unions on Wednesday at the same time as the results to come through. So if this does get voted through, it looks like the next question for Kelly Opberg, the CEO, is what are you going to do? How are you going to restructure this company? The existential questions about what parts of the business within Boeing remain, and how quickly can you get 737 MAX, 767 and 777 back on the production line to help your cash burn. Let's roll it over, stick with the airlines. Spirit Airlines has been given a lifeline, so to speak. They've got about $1 billion worth of debt maturing 2025 and 2026. Stock up 36% because they've been given an extension. Extend and pretend, one could say. You've got until December the 23rd to restructure your debt, and it's one of those sort of rinky-dinks that they're talking about. The US Bank National Association, it's a restructuring which may lean into the loyalty programs to help them get through. Let's just close it off with a quick look at Humana. The stock was down 42% on the year. Cigna are back at the table again. They want to try and put a merger together. Putting these two companies together would create a beast. $125 billion worth of market cap. And indeed, it would let these two health insurers bulk up and fight back at the pressure on the margins in the business. Bid this morning by 4.8%. Jonathan, good morning.
Manus Cranny, good morning to you. You've been missed. Welcome back. It's good to see you back. I want to pick up on Spirit just briefly. Spirit, JetBlue. The deal that never was. Imagine if we'd been able to make that deal. I would love a conversation with the administration about what's happened here. We're not going to let this deal happen, and then this one happens.
Basically, are you going to lose more jobs because you essentially have a company that will not last if it continues by itself? And that's something that people are going to have to deal with. At what point are mergers and acquisitions something that makes financial sense for companies and for jobs? And at what point does it really become counterproductive for capitalism?
Spirit had a lifeline. They were potentially going to get the cash injection they needed. And this FTC said no because of competition issues. It's a great question, Jonathan, and it's something that would be a fascinating conversation with Pete Buttigieg.
That stock is up in early trading. Elsewhere, investors waiting for fresh economic data this week, looking for further signs of economic strength. Aditya, Bhave of Bank of America writing the following. With the latest string of upside data surprises, client concerns have shifted from recession to re-acceleration. In our view, the economy is resilient, but there are enough minor headwinds to make re-acceleration unlikely. Aditya joins us now for more. Aditya, good to see you.
Thanks for having me.
So you don't believe in this re-acceleration story. So let's start there. What underpins that view?
Not yet. So we don't believe in re-acceleration yet. Let's talk about the recent data flow. Start with jobs. Obviously, fantastic jobs report for September, right? But we would think of that more like a mediocre student who aced one test. So good job, but we're not there yet in terms of, have you turned the corner, or is this really an A-plus labor market? I don't think it is just yet, right? And then if you think about the GDP, GDI revisions, the revisions were actually more to the older data, right, from early 2023, late 2022. So it's telling us a story more of a very resilient economy that's been holding on to around 3% growth in private domestic demand for 6 quarters. So it's not so much that we're re-accelerating, it's just that we've been growing well above what we thought trend was for an extended period of time.
What would change your mind? What would convince you?
So a couple of things could do it, right? The first one would be significant fiscal stimulus, but potentially after the election. But that would have to be over and above just extending the tax cuts, right? Because the tax cuts are status quo from the perspective of consumers and businesses right now. And then the other possibility is that you get a large negative supply shock. The economy is already running at potential. So with that negative supply shock, you could potentially overheat.
What is that negative supply shock? Is that sort of code for something?
Well, it could be a number of things, right? It could be geopolitics. It could be some significant disruption in terms of tariffs. Those are a few potential examples.
So you talk about the R word. It used to be recession.
Yep.
Now it's re-acceleration.
Yes.
And I love this because it sort of puts into cold relief the idea that maybe this market sees the tail risk as increasingly re-acceleration and not recession. Is that what you're seeing in some of the baseline data and some of the baseline analysis that you see coming out of Wall Street?
So the way we would talk about it is that 2-3 weeks ago, before we got the jobs report and the data revisions, we would have thought the risks to our outlook were slightly skewed to the downside, so more towards recession than re-acceleration. Now we think the risks are pretty balanced. But the base case for us is still an economy that just softens up a little bit, doesn't go into recession, not even close, as inflation continues to move back down towards target.
Putting this all together, what are you expecting on November 7th from the Fed?
We're expecting a 25 basis point rate cut. We are comfortable with that view. basically the last jobs report did the work of 2 jobs reports, right? In terms of really delivering job growth. Then you had the upside revisions as well. You really had everything you wanted. So I think they'll be comfortable doing another 25, but they don't really have to do a 50 anymore.
But what if we get a really good jobs report before that Fed meeting? Is there a chance they don't cut?
The bar would be very, very high for that for a few reasons, right? If you don't cut in November, you're basically admitting that you made a mistake in September by going 50. And you've already told us that, look, we can keep cutting for now with policy rates growth close to 5% as long as inflation continues to move back towards target. The last inflation print wasn't great, but it wasn't terrible either. So they should be comfortable still cutting for now.
So given the fact that essentially you're saying it's not that the economy is reaccelerating, but we're staying around a level that seems like it's above trend growth, how much are you saying that maybe we need to reassess how far the Fed can cut? You know, that sort of the target rate has to be substantially higher than we thought maybe 2 months ago.
So this is exactly the question that I think everyone's wrestling with, right? So that there could be a few reasons why the target rate has gone up. The first one would be that inflation's just not behaving the way we want it to behave, right? But that would be more of an overheating story. The other potential story is that trend growth has gone up, right? That could be because of labor supply, but it could also be because of productivity. So the other thing that's happening on November 7th, by the way, which is a little bit wonkish, is that at 8:30 we get the revised productivity data, which will include the GDP revisions, right? Nobody's paying attention to that because of the Fed and the election.
Correct.
But I think it'll actually be quite interesting because the story around productivity could change quite a lot. And that has significant implications for long-term growth as well as the terminal rate.
How much do you push back against people who say you can already see the trickle effects of the 50 basis point rate cut through the economy? You can already see mortgage rates coming down and bringing more people in. You could already see loan activity picking up on the margins. Do you reject that, or do you actually say, yes, in a way, on the margins, it has been stimulative?
To the extent that that's happening, it's got to be very, very marginal, right? I mean, they cut rates in the middle of September. We have some of the September data, right? We don't have any of the October data right now, so we really wouldn't see it in any meaningful way in the data right now.
Aditya, always good to catch up with you, sir. Aditya Bhave there of Bank of America. Distracted around the table just a little bit with news out of Disney. So check out Disney in the pre-market. This is what the stock is doing at the moment, just slightly positive. James Gorman of Morgan Stanley taking on a closer role at the company. The director in charge of planning for a successor to Bob Iger will become the chairman in early 2025, January 2nd to be precise. The executive chairman currently of Morgan Stanley, of course, that particular position, that term for that ends at the end of this year. And he's not going to take much for break, Bramo. He's going to take on the chairman role over at the Walt Disney Company. As for the CEO, we were waiting for an announcement. Succession. Give us the plan. Well, we've got a date. We expect to make an announcement in early 2026 to find out the replacement to Bob Iger.
So essentially, Bob Iger gets to stay at the helm of this company for another year. But James Gorman, what I love is that when he was retiring from Morgan Stanley, he was talking about he doesn't know what the next thing for him is and that maybe he'll take more time. This is sort of more time is to head over to Disney.
Well, he's busy doing other things. The Walt Disney Company right now, the pre-market positive by about 0.1%. We'll recap the details of that for you in just a moment. Looking ahead to a week full of economic data, plenty more Fed speak as well. But the one to watch is the next few weeks after that. When we get a payrolls report in a few Fridays' time, then the week after that, the US election in America, 2 days after November 5th, you've got a November 7th Federal Reserve interest rate decision. With us around the table, Bob Elliott of Unlimited. Bob, it's good to see you.
Good to see you.
Show. Let's get straight to it. In the bond market, yields are higher. Tell us the why. Why do you think this is happening? Why are we up by close to 50 basis points on a 10-year since this Fed cut rates by 50 basis points?
I think it's the perfect instantiation of the over-easy monetary policy that the Fed is pursuing. I mean, it is very unusual for a Fed to engage in aggressive cutting in an environment where we see real GDP growing at 3.5%, where we see the GDP gap basically at its highest level in several decades. And we see asset prices as strong as they've been, spreads low. That is not the type of economy that typically would get significant easing ahead. But the Fed is committed and the direction is clear, as Chairman Powell has said.
The bias is to cut interest rates. And that goes into an election where we could see even more debt issuance. When you start to think about where yields could go, we've got numbers on the Bloomberg today, people talking up 5 all over again at T. Rowe Price. Where do you think that yield is going right now?
Well, I think when you think about what's going on with bond yields, the key risk for rising bond yields is that you start to flow through to hitting stocks, right? Because bonds are in the stocks, whether you like it or not, and that discount rate both affects stocks directly and then, of course, starts to tighten economic conditions. And so moves in this range, we could probably withstand another 30, 40 basis points of 10 years moving higher before we start to run into some concerns that that's going to create a drag on the economy. And you're starting to see a little bit, mortgage refis have come down, mortgage activity down a little bit as mortgage rates have raised on the long end. And so, get a little bit more, 40, 50 basis points, that's when we start to get the concern. But there's a long way between where we are right now and getting up to those levels.
What are you pointing to as evidence that what we're seeing from the Federal Reserve with additional rate cuts is accommodation and not just normalization?
Well, I think the basic question is, what is neutral policy right now? And the Fed will give lots of different quantitative examples of and various models about what neutral is. But I like to look at neutral as an empirical question. And empirically, if the economy's been growing at 2 or 3% for the last 8 quarters, and inflation is above what their mandate is, and unemployment's at 4%, give or take, that's a pretty good economy at today's level of rates, and it's been a pretty good economy while these rates have been at these levels for an extended period of time. So I'd argue, at least in a time frame that anyone cares about, basically rates at these levels are neutral, not rates that are considerably lower.
If that's the case, do you actually see the potential for inflation coming back as a more serious concern? Is there a way that you're playing that through how you're positioning?
Yeah, I mean, if you look at the situation, we could have one of two paths. The first path is that the markets start to recognize this over-easy policy and start to price that in and actually get ahead of the actual economic conditions. And that's mostly what we've seen. Gold's up relative to bonds. Stocks are up relative to bonds. That's all indicative of the markets catching the Fed and saying too easy a path ahead relative to how strong this economy is. Otherwise, we'll have to wait quite a while before the actual stimulation at today's levels happens. We get a tightening of the economy, we get wage growth, and then finally we get inflation. But much more likely, we're going to see the markets get ahead of that, and that's exactly what we're seeing.
I loved your tweet last week. Gold and stocks greater than bonds. How much higher could we see gold? Because it feels like every day lately it's been a new fresh record.
Yeah, well, I think gold, the key thing to remember on gold is gold is a global asset. And so often we're here sitting in the U.S. thinking about gold relative to U.S. rates or U.S. real rates. But the vast majority of demand for physical gold is coming from China. And the direction of travel in terms of Chinese policy making is pretty clear right now, which is easier policy ahead, including what they announced in the last day or so. And so given that circumstance, you're going to continue to see a lot of demand for gold out of Asia as folks are looking for safe havens, right? It's not in their housing market. The stock market is, a bit of a casino. If you're really trying to, preserve wealth in the Chinese context, gold is the way to go. And it's no wonder that what we're seeing is easing out of China today, which is then having a knock-on effect of raising global bond yields and raising gold prices at the same time.
Mohamed Al-Aaron has a column today in the Financial Times talking about how the West needs to pay more attention to what's going on in gold because it's not just about a hedge or geopolitics. It's actually the fact that there might be de-dollarization. This is what happens when you have things like sanctions and tariffs. Does that mean that basically 2025, 2026, gold is just a place that we'll see more and more of these central banks dive into?
Yeah, I mean, obviously the central bank demand for gold has been very strong, particularly from those countries that are antagonistic to U.S. interests. I think the main thing to recognize with gold is we've got a $50 trillion global government bond market, and just a 1% move out of those bonds and into gold would be a huge pressure on gold to go higher because it's just very hard to create supply in the market, right? In gold, the way that you get incremental supply into the market when there's monetary demand is you have to scrap because essentially all the demand for monetary gold that's being produced right now is already being met. So you got to figure out ways to scrap gold and getting that, how do you get people to put cash for gold, respond to cash for gold ads on the television? Prices have got to go a lot higher to get that to happen.
I love that. Who are those catering to? Honestly, whenever I see that, I think, okay, what's the demographic?
Doomsayers.
Yeah, well, and also a certain age group. But I am curious, going forward, about how you view sort of the connection between yields and oil prices. I mean, a lot of the relationships have gotten a little bit skewed. And one thing that we keep talking about is that as oil prices go up, bond yields go up. Do you think that that's part of it, or do you really think it's entirely this macro story speaking to Fed?
Well, I think if we look over the last couple of weeks since the Fed laid out their over-easy policy, oil's traded choppily flat, and we've gotten this bond yield move. And so I don't think oil is primarily the driver. I think the big risk here, though, is that it wouldn't take much in terms of constrained supply in the oil market to create a spike in prices. And that is the worst case scenario for the Fed. Imagine, we're standing December 1st. We have a new administration that's very focused on tariffs. We have oil prices that are rising due to global conflict, and we have a strong economy. And that's going to be a real challenge for the Fed to navigate as they enter 2025.
Bob, this was great. It's good to see you. Thank you, sir, for breaking things down. Bob Elliott of Unlimited on the outlook for the next few months. The outlook for November, that first week of November. If we get a red sweep, certainly not a base case right now for many of you I know, and not guaranteed, nothing is. But if we get one, let's do some scenario analysis. We said on this programme earlier on this morning, you could envision quite easily yields moving 50 basis points. What would interest me that morning and the morning afterwards, for the next several days, are yields climbing because growth is going to be stronger, inflation might be hotter, the Federal Reserve has to maybe reconsider cutting and consider hiking, or are we getting a legitimate buyer's strike in the Treasury market accompanied with a sell-off in the FX market on the US dollar? We didn't see that when yields started to climb higher over the last few years in this country. It was typically accompanied with a stronger FX market, a stronger US dollar. If you get something different, and we got a little taster of that in the UK, where gilt sold off and the pound got weaker, if you get a little bit of that in America, all bets are off.
Well, Terry Wizman was talking about that would be basically the shift and the undermining of American exceptionalism if you get a dollar sell-off in tandem with higher yields. It's sort of the equivalent rhyme with a Liz Truss moment, and that is one of the big concerns.
Yields up this morning, 5 basis points, 413.22. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. As you mentioned, changes are coming to the C-suite at Disney. Shares unchanged this morning with the company named Morgan Stanley Executive Chairman James Gorman as the chairman of its board, effective January 2nd. He's currently the chair of Disney's board succession planning committee, which is working to identify the next CEO. Disney planning to appoint that new CEO in early 2026 to take the reins from current chief Bob Iger. Elliott Investment Management and Southwest Airlines may be heading towards a truce. According to people familiar with the matter, the two are discussing a potential settlement that would avoid a proxy fight for control of the airline's board. Elliott has proposed a framework that would give it representation, but not control of the board. The talks haven't been finalized and could fall through, according to the people familiar. And Anne-Marie promised I'd give a baseball update, so this is for you, Anne-Marie. The LA Dodgers are heading back to the World Series after eliminating the Mets in Game 6 last night. They'll be facing their longtime cross-country rivals, the New York Yankees, who are back in the Fall Classic for the first time since 2009. It'll be a battle of the league's top superstars, with Shohei Ohtani and Mookie Betts gearing up for LA, and Aaron Judge and Juan Soto representing the Pinstripes. And tough luck for those looking for a bargain on ticket prices. As of this morning, there are 0 tickets available for under $1,000 for games in either city. And that's your brief, John.
That's not a shocker to me at all. Danny, thank you. Outfit change around the table once again.
This is going to be such an expensive World Series. I thought you said you were coming with me.
No, not now. It's a midweek game. I'm a weekend guy only. I can't do this job and
This is why
game.
I'm upset with the Mets.
100%.
One, I really wanted the Mets to win. I really needed the Mets to win so that the Dodgers and the Mets, whoever the Yankees were up against, we exhausted them before that game. But then also, if the Mets won, we could have all went to the game. Me and you, Lisa,
Yankees
Friday
would have had
night.
a home game at the weekend, but that's not how this plays out. Lisa doesn't want to talk about this, so
I think that
we're not going to talk about
we should talk about bond yields. I think we should talk about auctions and the beige book.
Talk about Boeing next. Bond yields, auctions,
Yankees.
beige book, sprinkle of Yankees at the end. Up next, we'll set you up for the week ahead. The Trading Diary, just around the corner. Equities down just a touch. We're negative by 0.2%. Bond yields higher by 5 basis points, 413. 42. As we count you down to the opening bell, here's the trading diary, the calendar, the week ahead. The IMF full meeting begins today. Tuesday, results from GM. Wednesday, Tesla and Boeing report. Thursday, another round of jobless claims and PMI data, plus more earnings from UPS and American Airlines. And on Friday, durable goods and UMich consumer sentiment. As we look ahead to Boeing, the stakes high for earnings as union workers also vote Wednesday about whether to accept the plane maker's latest offer and end a 5-week-long strike. The stock is up by 3.4%. Joining us now, George Ferguson of Bloomberg Intelligence. George, it's a decent offer. Walk us through that offer and whether we can close a deal.
Sure. So I think the biggest point of the offer is Boeing's come back to about a 35% increase in wages, which seems pretty good, although a little bit shy of some of the 10% gains we've seen for organized labor in the marketplace. I think they've sweetened some of the 401k. They've talked, I think, about more matching. I think up to 12% matching. They've talked about providing, like I think, a $5,000 incentive into the 401k. But those are numbers I've kind of looked at this morning, quickly. So some of them may not be perfect, but I think you get the point, and that is they're trying to go back at the 401k, which it's been a challenge because the unions said that they wanted a pension, a return to the pension, which is really very difficult, again, for U.S. corporations. We haven't seen anybody roll back towards a pension ever, I think. And I think going ahead and trying to sweeten some of that increase in pay, but like I said, I think still a little bit short from what we've seen in the marketplace. So it'll be interesting to see how the whole this proposal goes down on Wednesday.
Just 30 seconds, George. How much can this company provide guidance without certainty about whether they will get a ratified deal?
You're not going to get any guidance. I think you're not going to get any guidance. They're not going to be ratified by the end of the day. You'll get nothing.
George, appreciate the update, sir. George Ferguson there of Bloomberg Intelligence. Setting the bar pretty low for Boeing earnings in a couple of days.
Just to consider this. It costs them an estimated $100 million per week that this strike goes on. This is 33,000 people. How do they provide guidance when they're basically hemorrhaging cash and they don't know when they can get things back online? So the key question is, how low is that bar for them to actually walk over at a time where there is this much uncertainty?
You think 35% gets it done? Feels like it might.
I mean, I don't understand what the holdup was, because it was sort of this long-term parameter of what the future looks like, and that has to do with pensions. I don't know what kind of nod they got from the White House, because that was part of the discussions. A lot of question marks around this, especially without the union leaders signing off on this deal.
It's not the only challenge this company's got right now, and we can all agree on that. The stock is up by a little more than 3% in the pre-market. Coming up tomorrow, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to Torsten Slok of Apollo. The RBC CEO, Dave Mackay, is going to join us on this programme, and we'll speak to Gilles Moek of AXA. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.